What if you are a business owner? What becomes of your business? How will you cater for your daily expenses during your injury period? Are there any medical expenses as a result of an accident, and how do you cater for them? What of permanent disability? When you are unable to continue with your normal productivity? What of death? How will you leave your dependents? Many questions, few answers. Do not worry, because I am here to tell you how you can ease the burden that comes with these unplanned, unfortunate events through personal accident insurance policies, which are very, very cheap, by the way. This is Insurance World. Subscribe and activate the notification bell so that we move together. We are building a community of insurance woke citizens and would like you to be part of us. Personal accident insurance, or an accident insurance policy, as it may be referred to, in other words, is an annual policy that will pay cash benefit to a policy owner in the event he or she suffers injuries that would require medical attention, loss of income due to temporary or total disability, or pays lump sum to dependents upon the death of a policy owner caused solely by violent, accidental, and most common benefits some amount to your declared dependent in the event of your demise, caused by an accident or accidental means. 2. Permanent disability benefit. This benefit pays a lump sum amount paid to you, as the policy owner, when you are permanently disabled by an accident. Such permanent disability includes loss of limbs or blindness or even loss of speech or hearing ability. 3. Temporary disability benefit. This benefit pays for the loss of weekly income that you will lose as a result of being incapacitated by an accident. Whatever amount you are making weekly or daily as an employee or as a business owner, funded by the policy so that you don't lose your livelihood during this time. 4. Medical expense cover. This benefit will reimburse you the cost of the medical expenses and treatment you have incurred while attending to your injuries caused by an accident. 5. Cost of artificial appliances. This benefit will provide funds for purchasing appliances such as clutches, wheelchairs, corsets, prostheses, hearing aids, etc., which will aid you in managing the injuries. 6. Last expense cover. This benefit pays a lump sum amount to the family to assist them in organizing for a decent send-off when the policy owner passes on. These are the basic benefits under the personal accident cover. However, some policies will endeavor to widen the cover to provide other benefits. This is agreed on policy by policy as per your need as the policy owner. Make sure your agent or broker explains the other extensions. Request as many benefits as possible. Having understood what a personal accident is, let us now look at why you need it. What is the importance of having a personal accident insurance policy? Number 1, it protects family income. Both temporary and permanent injury benefits ensures that the family is provided for when the policy owner is injured. 2, it augments the medical insurance policy. Medical expenses extensions will reimburse any accidental medical expenses, hence ensuring that your medical limit is preserved for illnesses. You know how medical costs are high in this country, don't you? Any savings is a welcome bonus. 3. Permanent disability benefit protects the policy owner against job loss. 4. With all of the above benefits and more, it surely guarantees peace of mind. Do you agree? Leave us a comment. How do you activate your benefits under personal accident cover? Claims procedures under personal accident are simple. Number 1. Being an accident, you need to get first and emergency treatment first. Go or be taken to the hospital to get proper treatment. When you are better, fill in a claim form and attach receipts together with any medical reports and send it to your insurer for reimbursement. For temporary disability, the doctor will give sick-off sheets which will determine how long you will be off work. The insurance company will pay for the loss of income for the sick-off days. For permanent disability, your doctor's report will advise the insurance company of the nature of the disability and how much needs to be paid. Last expense claims are paid after the presentation of a copy of a burial permit. On death, forward the death certificate and a copy of an identification document together with a duly completed claim form to get compensation. depending on the nature of the accident. You may be required to present a police abstract report. Your insurance company will also guide you on any other requirements to be provided so that the claim is paid. We are through for today. What do you think about this policy? Visit your agent or broker and get one. Or send us an email and we will look you up with the best personal accident cover. We are up to the task and you know it. Let's meet in another one of these videos tomorrow.
My name is Jannik Volskink. I'm the Reaction Team Gates and Canine Manager for Sabi-Sand Nature Reserve. Rhino poaching has decimated populations across the landscape. We have to get up every single day to try and stop it as much as we can, using whatever we can. DJI drones is some of the technology that we've brought in back in 2021, creating a role that can't be matched.
Sabi-Sand is situated towards the west of the Kruger National Park. It's about 65,000 hectares. If you look at the Sabi-Sand, the landscape that we've got with the vegetation we have here, it's ideally suited for the white rhino as well as black rhino.
So the DJI drone has helped us immensely in terms of deploying something in the air quickly, getting to an area where we don't have to make a lot of noise and disturb the area where poachers can hear us, and it gives us a visual of the poachers on the ground before we initiate the teams moving in closer.
We were very impressed with the Matrice 40's night capability. It's really, really crisp and nice and clear, and you can see your objective that you're looking at very, very nicely. Coupled with the spotlight it's got on, you can see exactly what's happening at that specific location where you're focusing on.
And the drones are multi-use. It's not just security, it's conservation. It's a constant use on the reserve, and it's all over the place.
It's critical that we have these drones with us so that we can locate these animals, know their movements, know where they are, look at their conditions, and also get their notch numbers so that we can record it and make sure that that animal is supposed to be in that area and it hasn't been chased out by another animal. So the zoom feature on the M40 is absolutely amazing. I could literally find a tick on a rhino at 300-400 meters away. The 7x zoom and its capability is just phenomenal.
Seeing effects like the AI being integrated into the Matrice 40 makes me very excited for what drones could be doing in the future as well. Whether it's recognizing key species, no matter how big or small, while in flight, and keeping track of them as well, would massively boost the efficiency of drones within conservation and protected areas across the world.
For game reserves such as Sabi-Sands, we're able to provide them with technology such as the DJI Matrice 40, which is equipped with thermal imagery, zoom capabilities, enhancing for use to combat their anti-poaching efforts.
People outside, like our families and children, like they're still growing up, they still want to see a white rhino, what it looks like, and then so it breaks my heart when rhinos getting poached.
At the end of the day, for me, it is working with a team where everyone pulls their weight. Our record speaks for itself. Over 400 days now, incident-free, and it's that cohesive team effort that makes it successful, and that's what makes you sleep better at night.
Despite economic headwinds, we saw a lot of potential and growth last year. We saw gains in the banking sector of about 27%. We also then saw gains in energy and petroleum sector, slightly over 50% in that space. Overall, the Securities Exchange did well. there was quite some robust growth. We saw the market capitalization go up by 419.5 billion, which brought it to about 1.9 trillion Kenya shillings, a growth of slightly below 30% per annum.
Talked about the Eurobond, and it looks like the spectra of debt service, will continue to haunt us for a few years. And that's because, not my numbers, but the IMF. If you read the IMF staff report, on average, for the next 3 to 4 years, Kenya has $4.8 billion to roll over in external debt.
The government struggling slightly to raise funding on the treasury bills and bonds. It's going to be expensive for them to raise debt, but also might get into a situation whereby taxes will be increased. The other one would be debt sustainability. Debt to GDP at 70%. That is likely going to be a key challenge going into the year. In terms of resilience, the market is still resilient. We're seeing strong performance at the Nairobi Securities Exchange. We're also then seeing certain sectors, again, such as banking, which are showing quite some promise. You're seeing the likes of JP Morgan come in into the market, just showing that there's a lot of potential there. And then again, energy and infrastructure remains robust, where we expect to see more growth.
There are massive opportunities in AI, and I do think it's going to be transformational, and it's going to increase and transform productivity across our economies. We can't avoid it. We have to adapt and grow with it.
The first thing that Kenya businesses can do is embrace this change in technology, bring these technological changes into their businesses. So first thing is embrace. Secondly, strengthen their workforce, their human capital, so get proper training, get the right people on board. We'd also talk about a situation whereby it foster partnerships to strengthen your proposition and help you capture opportunities with these changes in AI and technology. Lastly, enhance the use of data analytics to have better decision-making capabilities for these businesses. And so I believe those are I'd say 3 or 4 points that businesses should look at with these changes in technology and AI.
Your health is your wealth. An old saying emphasizing the importance of good health or being healthy. Being healthy is divine, maintaining your good health is a grace from God. Restoring your health when an illness strikes is to a large extent your own effort. Getting a good medical treatment, in today's world, largely depends on which hospital you visit and how much you pay for it. Falling sick or getting involved in an accident that requires medical attention is a risk that no one knows when it is likely to happen, and as it is with all risks, there is an insurance policy for it. Medical or health insurance may appear as an option for many of my countrymen and women. It is important, almost critical, to have medical insurance, since the opposite of this spells doom. With no cover, hospitals will not even look at you twice, or if they do, you will have paid a deposit in cash. An amount that is way above the premium you would have used to purchase a medical policy. If you take your health or that of your loved ones seriously, then watch this video. I have a suggestion on the best individual and family cover for you. Before we continue, take a second and subscribe and activate the notification bell to join our community. Health or medical cover is an insurance policy that pays for the hospitalization and treatment expenses of a policy owner and his or her dependents who are covered in the policy.
No. Say Zeiss.
When our engine stops, our drive continues. A new opportunity, driven to be better than before. We go again, as we prepare for another race. This way of life is not for everyone, but I would not trade it for the world.
When you purchase a medical cover, you are transferring the management of medical expenses to the agreement terms in the policy you have purchased. Having been here for a while and interacted with various individual medical policies severally, this is the best I have come across. I will not say who is the provider for now. I will leave that for you to contact me for us to discuss. The health insurance policy I am talking about is designed to cover individuals or families, and it provides inpatient cover, maternity cover, outpatient cover, dental cover, optical cover, and last expense cover. This particular medical insurance product has annual inpatient limits ranging from 500,000 shillings, 1 million shillings, 3 million shillings, 5 million shillings, and 10 million shillings. This product has a maternity cover inbuilt within the inpatient limit as follows. For an inpatient limit of 500,000 shillings, the maternity cover limit is 50,000 shillings. An inpatient limit of 1 million shillings has a maternity cover of 75,000 shillings. An inpatient limit of 3 million shillings has a maternity cover of 100,000 shillings. An inpatient limit of 5 million shillings has a maternity cover of 150,000 shillings, and an inpatient limit of 10 million shillings has a maternity cover of 200,000 shillings. The outpatient limits here range from 50,000 shillings, 60,000 shillings, 100,000 shillings, 150,000 shillings, and 200,000 shillings. The policy has a dental and optical covers with various limits which are available as per the cover rules. These are the full options under this cover. The above is the outlay of this cover. However, what makes it great and top of the line from other covers are the following. 1. It is a lifetime cover, meaning, once you join, you can renew your cover for life until you expire. No maximum age. 2. Wide geographical coverage and hospital network. Access to a comprehensive network of hospitals across East Africa. Overseas referral is available for conditions not covered locally with accredited overseas partners. Air evacuation for cover limits above 1 million shillings. Road evacuation for all cover limits. Overseas emergency treatment cover of 42 days on reimbursement for cover limits of 1 million and above. 3. It is affordable cover with relatively competitive premiums and no excess for inpatient cover. 4. The cover has enhanced sublimits which are relatively higher than that of his market peers. 5. Comprehensive benefits. Inpatient limits from 500,000 shillings to 10 million shillings. Optional outpatient cover from 50,000 shillings to 200,000 shillings. 6. Cover for passive war and terrorism and political violence. 7. Lodger fee for accompanying parent or guardian of an admitted child aged 12 years and below. 8. Evacuation within East Africa road and air ambulance accidents to overall limit. 9. Has a cover for newly diagnosed chronic illnesses. 10. High chronic, pre-existing illnesses, congenital conditions and HIV, AIDS limits. 11. It has an organ transplant cover. 12. Psychiatric and psychological illnesses. 13. Includes post-hospitalization 21 days after discharge. 14. Includes cover for neonatal and prematurity conditions. 15. Inpatient non-accident related dental surgery treatment. 16. Inpatient non-accident related eye treatments. 17. Accident-related inpatient dental and ophthalmological treatment. 18. Accidental and illness-related reconstructive or plastic surgery. 19. non-accident related maxillofacial surgery. 20. Gynecological surgery. 21. Cost of purchase of internal and external surgical implants, appliances, and prostheses. 22. Maternity cover of up to 200,000 shillings to pay for normal delivery, elective and subsequent cesarean sections, first ever emergency cesarean section, ectopic pregnancy, and maternity complications before and after delivery. 23. COVID-19 treatment of up to 250,000 shillings for moderate cases and up to 1 million shillings for critical cases requiring ICU or HDU. The critical COVID-19 cases limit is a cumulative amount that will be inclusive of any amounts already paid for in the treatment of moderate the best feature of this policy. The policy has introduced a first-of-a-kind critical illness extension. A critical illness extension is a benefit under the policy which will pay a lump sum of 750,000 shillings upon first positive diagnosis of critical illnesses such as cancer, stroke, heart attack, renal or kidney failure, paraplegia or paralysis. This concludes our topic today. We have endeavored to bring out the best in this medical insurance product. We hope to have swayed your opinion, though the time did not do us justice. A brochure for this product would explain more. Leave a comment below and we will share the brochure for further information. If you would like us to tell you more about the cover, contact us via the email given in the description.
Hello there, how are you doing today? I am excited today as we present to you part 2 of our research on insurance in the Bible. If you have not watched part 1, please watch it here. If you have, let's go. Just by a way of emphasis, the Bible does not mention insurance specifically, but it does discuss principles that can inform a Christian's approach to insurance and financial planning. Here are a few verses we have looked at in the Bible, and in our own interpretation, they teach principles applicable to insurance. 1. Proverbs chapter 6 verse 6 to 8. 2. 1 Timothy chapter 5 verse 8. 3. Acts chapter 2 verse 44 to 45. 4. Galatians chapter 6 verse 2. 5. Proverbs chapter 21 verse 20. 6. 1 Corinthians chapter 12 verse 25 and 26. 7. James chapter 2 verse 15 to 16. 8. Proverbs chapter 21 verse 5. 9. Matthew chapter 25 verse 14 to verse 30. 10. Proverbs 27 verse 12. Let's now look at them in turns. The first example, Proverbs chapter 6 verse 6 to 8. The Bible teaches about the importance of planning for the future in Proverbs chapter 6 verses 6 to 8. This verse states, "Go to the ant, O sluggard, consider her ways, and be wise. Without having any chief, officer, or ruler, she prepares her bread in summer and gathers her food in harvest." This passage teaches the importance of being diligent and proactive in planning for the future. This can be seen in people who purchase long-term insurance products such as life assurance, education policies, as well as savings on pensions for retirement. When employed, it is summertime, prepare the bread for winter. The second example, 1 Timothy chapter 5 verse 8. But if anyone does not provide for his relatives, and especially for members of his household, he has denied the faith and is worse than an unbeliever. This passage highlights the responsibility of individuals to care for their loved ones and provide for their needs. Provide health insurance for your family. Purchasing life assurance ensures you leave inheritance to your household. This verse places a responsibility on individuals to take care of their own and their family's needs, which could include having adequate insurance coverage. Additionally, the Bible warns against greed and unjust gain in 1 Timothy chapter 6 verse 10. The other example is in Acts chapter 2 verse 44 to 45. And all the believers were together and had everything in common. Selling their possessions and goods, they gave to anyone as he had need. These verses describe the community of early Christian believers in Jerusalem following the events of the day of Pentecost, where the Holy Spirit descended upon the apostles and they began to speak in various languages, leading to many people becoming believers. The verses indicate that the believers were unified and shared their resources with one another to meet the needs of those in the community. This encourages pooling of resources to help the less fortunate people or people who are unfortunate enough to have fallen below the living means. Example 4, Galatians chapter 6 verse 2. This Bible verse emphasizes on the principle of bearing one another's burdens and caring for those in need. Example number 5. Proverbs chapter 21 verse 20. This verse states, "In the house of the wise are stores of choice food and oil, but a foolish man devours all he has." This verse emphasizes on savings for a future of abundance. Insurance products such as pensions, education policies, and life assurance policy can be used to save this future. He who does not have any of the aforementioned products are the foolish ones who devours all their income. The Bible said that, not me. On to example number 6. 1 Corinthians chapter 12 verse 25 and 26. These verses states, "So that there should be no division in the body, but that its parts should have equal concern for each other. If one part suffers, every part suffers with it. If one part is honored, every part rejoices with it." This is a tough one to explain. Let me ask Chairman to do so next Sunday. Example number 7. James chapter 2 verse 15 to 16. In the book of James chapter 2 verse 15 to 16 states, "Suppose a brother or a sister is without clothes and daily food. If one of you says to them, 'Go in peace, keep warm and well fed,' but does nothing about their physical needs, what good is it?" These verses suggest that the Bible values wise financial planning, mutual support, and caring for the needs of others, which may align with the principles of insurance. This verse encourages caring for others. 8. Proverbs chapter 21 verse 5. "The plans of the diligent lead to profit as surely as haste leads to poverty." This verse emphasizes the importance of wise planning and preparation, which can be seen as applying to financial planning, including the need for insurance. The Bible encourages wise planning and stewardship of resources in Proverbs chapter 21 verse 5. Number 9. Matthew chapter 25 verses 14 to 30. Matthew chapter 25 verse 14 to verse 30 tells the parable of the talents, which teaches that we are responsible for using what we've been given, including our resources, to produce a return. This could be seen as supporting the idea of protecting one's assets, including health and property, through insurance. The final chapter for us today, Proverbs chapter 27 verse 12. "The prudent see danger and take refuge, but the simple keep going and suffer for it." This verse can be interpreted as promoting the importance of being prepared for unforeseen events and taking steps to protect oneself and one's family. So, while the Bible does not mention insurance specifically, these and other passages could be applied to the concept of insurance and the responsibility to plan for the future and care for oneself and others. It's important to note that these verses are open to interpretation and that Christians may have different perspectives on what the Bible says about insurance. Ultimately, how one approaches insurance should be guided by their faith and informed by wisdom and practical consideration. Thank you for watching. Our study on the Bible and insurance continues. Look out for more to come soon. Kindly subscribe, like and share. Activate the notification bell and let's meet again soon.
Hello there, my friends. Welcome or welcome back to our channel. We appreciate your loyalty and commitment. Saving is an integral part of wealth creation. Our topic today touches on savings and investments suitable for an individual of a group, commonly known as chamas. If you are new here, don't allow yourself to become a stranger. Kindly subscribe and join our community. On this beautiful day, I want us to talk about the 365 Days Savings Challenge, and I will show you how to achieve it in less than 12 months. I have a tried and tested method to share with you. Let's get it on. What is this 365-day challenge? A 365-day challenge is a savings proposition designed by some bright individuals and some good people to encourage you to save money each and every day of the year. Any year, other than leap years, will have 365 days. This challenge encourages you to save an amount equivalent to the number of that day in a year. An example: January 1st, being the first day of the year, you save 1 shilling. On the 2nd of January, you save 2 shillings. And on the 31st day of December, being the 365th day, you save 365 shillings. If you follow this method religiously, you will end up with a total savings of 66,795 shillings by the end of the year, as illustrated below. Your savings for the entire month of January will amount to 496 shillings. February, 1,274 shillings. March, 2,325 shillings. April, 3,165 shillings. May, 4,216 shillings. June, 4,995 shillings. July, 6,107 shillings. August, 7,068 shillings. September, 7,755 shillings. October, 8,959 shillings. November, 9,585 shillings. December, 10,850 shillings. Totaling to 66,795 shillings. Understood up to that point? Good. Now, for us to achieve this amount of savings in less than 12 months, I am going to tell you how to combine this savings plan with an investment instrument that will earn you interest so that your money grows as you start to save. Walk with me. Your daily savings can be collected in a piggy bank at home, or sent to your mobile money account, or your bank account. For investment, I suggest for you a unit trust investment scheme because it is easy to open and operate, and you can add your savings at any time, any day, especially with mobile money. Your added investment will be credited on the next working day and start earning interest immediately. In Kenya, a good unit trust will earn you an average of 8.5% per annum. This interest is declared and added to your unit trust savings monthly. Your unit trust provider will also send you your monthly statement showing cumulative total savings and interest earned for the respective months. This is another one of the records you need to be keeping in your file every month. For this particular challenge, you can choose any of the unit trusts or ask your financial advisor for guidance. Then open your money market account or reassign your existing one for this challenge. Personally, I have used CIC, Sanlam, Britam, and Old Mutual money market schemes. My experience with them is a story worth another video altogether. Maybe I will do that video in my next post on the subject. Now, you have 3 things for the challenge. Number 1 is the will to save. Number 2 is where to save, and the third is your unit trust account. Don't forget a book where you will record your progress. This is actually the best time. If you started this savings challenge at the beginning of the year, you have saved 300 shillings by today, the 24th of January. If you have not, then you can save 300 now and mark that as savings from the start of the year. Let's add that investment twist to it now. By the end of January, you will have saved 496 shillings following this challenge. Take these January savings and add 1,092 shillings to it, then mark that additional amount as savings for December 31st at 365 shillings, December 30th at 364 shillings, and December 29th at 363 shillings. Doing this, you will have closed both ends of the table so that you start dealing with the middle. This narrows down the task and makes it achievable. Take the total saved amount up to the end of January totaling 1,588 shillings and send it to your unit trust account so that it starts earning from the 1st of February. At the end of February, your January savings of 1,588 shillings you sent to your unit trust account will have earned you an interest of 11 shillings, and thus your unit trust total will be 1,599 at the end of February. In the month of February, you will have saved 1,274 shillings. Add 1,000 shillings to it and mark it for the 28th, the 27th, and the 26th of December as we did the extra savings in January. This makes total savings for February amount to 2,274 shillings. Send this to your unit trust account, which by now has both savings and interest amounting to 1,599 shillings, and this makes it 3,872 shillings to earn interest in the month of March. At the end of March, you will have earned a compounded interest of 26 shillings for the total savings. And cumulative unit trust balance at the end of March will be 3,899 shillings. Your total March savings up to the end of March will be 2,325 shillings. Add another 1,000 shillings to this and send it to your unit trust account. When you add this to your unit trust account, the total will be 7,224 at the start of April, and this will earn you an interest of 49 shillings by the end of April, so that you close April with a total of 7,272 shillings in your unit trust account. We continue with our savings in April, and by the end of it, you will have saved 3,165 shillings and, as the norm, add 1,000 and send it to your unit trust account. The total amount in your unit trust account for the month of May will be 11,457 shillings, and this will earn you an interest of 77 shillings by the end of May. May unit trust closing balance will be 11,514 shillings. Following the same pattern, May savings will be 4,216, add 1,000 to it and send it to the unit trust account, and the total in the unit trust will be 16,730, which you will invest in the month of June, and at the end of June, this will earn you an interest of 113 shillings, closing at 16,843 shillings. June savings will be 4,995, add 1,000 and send to your unit trust account at the end of June to bring the total to 22,838, which will earn you an interest of 154 shillings by end of July, closing the month at 22,992 shillings. July savings will be 6,107, add 1,000 then send to your unit trust account, and this will bring that total to 30,099, which will earn you an interest of 203 shillings at the end of August, closing the month at 30,301 shillings. August savings will be 7,068, add 1,000 then send to your unit trust account, and this will bring that total to 38,369, which will earn you an interest of 258 shillings in September, closing the month at 38,627 shillings. September savings will be 7,755, add 1,000 then send to your unit trust account, and this will bring that total to 47,382, which will earn you an interest of 319 shillings in October, closing the month at 47,701 shillings. October savings will be 8,959, add 1,000 then send to your unit trust account, and this will bring that total to 57,660, which will earn you an interest of 388 shillings in the month of November, closing the month at 58,048 shillings. November savings will be 9,585, add 1,000 then send to trust account, and this will bring that total to 68,633. Closing the month at 68,633 shillings. At the end of November, you realize that you will have already reached 68,633, which is over 2,000 shillings more than the set target. You will note that interest earned during this time amounts to 2,043 shillings. Isn't that great? December savings target will have been taken care of by the 1,000 shilling savings you have been adding at the end of the month, and thus, you have achieved and surpassed the target with 1 month to spare. Do you see the power of compounded interest? You can now plan a holiday or that purchase, or that investment you were saving for, with a whole month to spare. Or, if you were to continue to invest the end of November amount in December and save for the month of December, the total savings will be 10,850 at the end of December. Add 1,000 to it and the total amounts realized from savings and interest earned will be 80,945, this without earning interest for the December savings. Tips on how to keep a steady momentum. Always put some of your spare change towards this savings account. An example is when you have some 100 save it, then go and mark the 153rd day as achieved. When you remain with 204 or 313 or 107 as spare change, do the same. Do this as many times as possible. These random savings will lessen your burden, especially as the number is moved towards the end of the year where the required daily savings amount increases exponentially. If possible, make your random savings clear your targets starting from the end of the year and running backward. If you reach a day where you already saved your target amount, save for another day. If the amount at hand for the random savings does not total to amount designated for any other day, just put it anywhere and add a plus sign to signify that you have saved halfway on that day, and you need to come back and save the rest. Now that we have come to the end of the video and you have the concept, rewatch this video, this time, with a paper to record or an Excel sheet for confirmation. If you are an accountant by profession or an investment enthusiast, create an Excel and follow the daily developments. If you don't fancy Excel like my friend D, just set the savings plan in motion, meet your targets, and ensure you get, scrutinize, and file your monthly unit trust statements. You will not go wrong. Now, the life we live throws us challenges here and there, and you may find that as the year progresses, the shoestring becomes tighter, and you may not be able to meet the daily targets. Not to worry. Just save any amount available. I say, whatever you have saved will be a good start, and the best you could do given your situation. So, don't look at the figures and write yourself off even before starting. You lose if you don't start. Secondly, the amounts given in the tables are scalable, meaning you can cut them down by half or increase them by doubling or even tripling. The idea here is to form a habit of saving and investing. The third thing I would like to say is that maybe you have seen this video or came across this challenge later in the year, and the amounts that you need to save from the beginning of the year to be in tandem with others is too huge for you to manage. Start from any day and make it your first day and progress from there. You will still have one at the end of the year. And with that, I leave you and pray that you start or keep the momentum, and let's meet again later in the year as we take stock. For this challenge is for you too. The exchange rate for US dollar against Kenya shillings. $1 is equivalent to 123 Kenya shillings. Kindly comment and share your experiences for others in our community to learn. All questions posted in the comments will be answered promptly. We will be conducting community posts to detail our collective progress. Thank you for watching. Give us a like if the video provided you with value. Hello everyone. I am Jane. Welcome to our channel. Today, we take a look at motor vehicle insurance policy excess. An insurance excess, for the purposes of learning, is defined as the first part or portion of a claim that the policyholder is required to pay towards his or her claim, usually expressed as a percentage of the total insured item value. The primary reason why insurance policies impose an excess is to instill a duty of care and discipline in the policyholder towards the insured item and eliminate moral risks or hazards. Moral hazard refers to behavioral changes towards an insured item that might occur and increase the risk of loss when a person knows that insurance will provide coverage. When a person can avoid the potential consequences of a risk, their actions and attitude change, and there is a greater likelihood of a moral hazard. When one insures property such as a car, they have transferred the risk to the insurance company, but the insured item is still under their care, and because of this fact, it is important for the insurance company to ensure that the policyholder does not cause a loss or provide an environment for a loss to occur. It has been confirmed that when one knows they will be called upon to pay the excess, they tend to eliminate or minimize situations where a loss might occur where they will be forced to claim and pay excess. Having defined what excess is, and understood the primary reason why it is imposed on a policy, let's now see what are the excesses applicable to a motor insurance policy. The main excesses under motor insurance are 1. Own damage excesses. 2. Theft excesses. 3. Third-party excesses. 4. Young and inexperienced driver excesses, also known as novice excess. 5. No blame, no excess clause. Own damage excess. This is an excess applicable to motor claims where the vehicle is damaged either through accident, partial theft, or fire and it has taken for repairs. The own damage excesses apply as follows. For motor private insurance, the standard excess is 2.5% of the vehicle value. Minimum and maximums vary with each policy. For motor commercial insurance, the standard excess is 5% of the vehicle value. Minimum and maximums vary with each policy. For motorcycles policy, the excess may start from 3% of the motorcycle value, or an amount set by the insurer. Minimum and maximums vary with each policy. When the car is taken in for repairs, the policy owner will be required to pay the excess before the car is released back to them. There are 2 instances where the policyholder will not be required to pay the excess. If the policy has an excess insurance. If the policy owner was not blamed for the accident and the policy has no blame, no excess clause. When should you pay own damage excesses? Own damage excess is payable to the insurance company when the repairs have already been authorized. The vehicle will not be released from the garage if the excess is not paid. If the policy has an excess protector extension, notify the insurer when claiming for them to activate the claim. If the policy has no blame to excess clause and you are not to blame, bring this to the attention of the insurer for them to apply the clause. Theft excesses. These are excesses applied when the car is stolen, and the insurers are compensating for the total theft of the insured vehicle. In this instance, the insurance company will pay the insured amount less these excesses. Excess rates for theft claims apply as below. Motor private. Theft excess is 10% of the vehicle value if the car is fitted with an anti-theft device and 20% if the car is not fitted with an anti-theft device. Minimums and maximums are different for each policy. Motor commercial. Theft excess is 10% of the vehicle value if the car is fitted with an anti-theft device and 20% if the car is not fitted with an anti-theft device. Minimums and maximums are different for each policy. FO motorcycles. The same rates as the 2 above may apply, or each insurer will have their own standard. When will you be required to pay motor theft excess? Motor theft excess is deducted from the total amount of compensation you are set to receive from the insurance company. An example is, if the value of the insured car is $800,000/equals, the settlement will be the value less 10% or 20% of that value, whichever is applicable. The third excess under motor policy is third-party excess. Under motor vehicle insurance, a third-party claim arises when the insured car accidentally injures a passenger in your car or a member of the public or damages someone's property. These third parties will hold the car owner liable and claim compensation from them, usually through the courts. Each of these third-party accidents will be documented and claimed separately from each other and from accidental damage claim in case the accident touched on 2 or more of the third-party incidences. Third-party excesses apply as below. 1. Third-party bodily injuries. No excess is applicable. 2. Third-party property damage. The excess is $5,000 for motor private and $10,000 for motor commercial. Motorcycle third-party excess vary from one underwriter to another. Where third-party excess is applicable, one is required to pay the same to the insurance company as soon as the third-party claim has been lodged. Third-party claims are lodged by issuing a demand letter or a notice of intention to sue. The fourth excess is novice or young driver excess. Novice refers to a person with little to no experience in a certain field. For the purposes of insurance, a novice is someone who has a provisional driver's license or someone with less than 1 year of experience in driving or as defined in each policy. A young driver, in this case, referred to someone who has not reached the age of majority, as may be defined in each policy. Having a novice or young driver control of vehicle steering exponentially increases the risks, and as such, insurance companies will penalize the policyholder in case they cause an accident. Novice or your driver excesses are $5,000 for a motor private policy and $10,000 for a motor commercial policy. Each underwriter may also define their own limits. Motorcycle is defined by each underwriter. No blame, no excess clause. This is not an excess amount payable by cash, but rather, a clause inserted into a motor policy to provide relief to a policy owner when his or her car is involved in an accident where he or she is not at fault. The clause provides that the insurer will pursue that third party blamed for the accident directly to recover the excess. The only thing insurers will require here is a police abstract indicating the name and contact details of the third party at fault. What you can do as a policy owner to benefit here is to ensure that your policy document indicates this clause and clearly explains its application. Excesses are out-of-pocket expenses for a policyholder and are inconvenient. Some insurers offer policies that can cover the amount you will be required to pay as an excess when a claim occurs. This is known as excess insurance or excess protector insurance. In Kenya, the most common excess protector policies are purchased under motor insurance excesses. However, the excess policy can apply to just about any insurance policy. Benefits of purchasing an excess protector policy. Just like in any insurance policy, an excess policy will save you money when there is a claim that requires you to pay the excess. It also protects you against uncertainties. A claim may occur anytime and, more often than not, it will happen when coffers are dry. Types of excess protector policies under motor insurance. A policy owner can decide to purchase the excess insurance for any of the excesses we have covered above on damage, theft, fire, third party, jointly as one, also called all excesses insurance, or severally depending on their preference. Excess protector cost or premium calculation. Excess protector policy is a percentage of either the car value or the highest excess amount. Example: accident excess is 2.5% of the car value, or an amount agreed by the insurer. All excesses rate is 10% of the highest amount one would ordinarily pay as an excess, or an amount agreed on by your insurer. That marks the end for us today. Let's meet again soon. Subscribe and check out our community tab for exciting polls. Let me know what you would want me to cover in our next video by leaving us a note in the comments section.
Hello there. I hope you are well. Just a quick question for you, three practitioners. What is the difference between carrier's liability policy and goods in transit policy? A carrier's liability cover is an insurance policy that covers the policy owner against legal liability for accidental loss or damage to other people's goods in the custody or control of the policy owner while being transported either by road, rail, or other specified means. Goods in transit, on the other hand, covers your own goods against loss of or damage by fire, theft, or accidental means whilst the goods are in transit in a road vehicle or train or housed during the ordinary course of transit. Who is insured? Carrier's liability insurance covers the transporter when transporting goods belonging to other people who hire the policy owner to transport their goods. Goods in transit insurance covers the policy owner's goods when transporting his own goods, usually to a warehouse or his business place. What type of policy? Carrier's liability is a liability type policy. This means that the policy will pay third parties when goods being transported are lost or damaged due to the negligence of the policy owner. Good in transit is a property policy that will compensate the policy owner for losses or damage to his or her own goods while being transported. Who should buy these policies? Carrier's liability policy is suitable for transporters or transport contractors. People who transport goods and items that don't belong to them. Goods in transit policy is suitable for a businessperson transporting his own goods to a warehouse or to a business premise. Comprehensive videos on each of these two policies will be out shortly. Look out for them. Meanwhile, please subscribe, comment and share. Give us a thumbs up if the video provided you with value. Don't forget to activate the notification bell.
Greetings, my good people. I hope this video finds you well, just as emails do. Today, let's demystify this thing called Motor Vehicle Third Party Only Cover, or TPO in short form. What is motor insurance third party only cover? Third-party insurance offers protection against damages to the third party by the insured vehicle. It offers financial compensation to third parties who suffer physical injuries, or damage to their vehicle, or damage to their property, or death. It also extends to cover injuries to passengers while traveling in your vehicle, should they or their survivors choose to sue you for compensation for their injuries or death. I have seen cases where passengers who were in a car at the time of accident suing the car owner for injuries they suffered when the car got involved in an accident. The term third party was coined during the early insurance contracts development to refer to any other person who is not a party to an insurance contract. The insurance contract is between the owner of the insured car, referred to as the first party, and the insurance company taking up the risk, referred to as the second party. Anybody outside that definition is the third party. These people outside the contract are the ones covered by the third-party insurance cover. This insurance is mandatory by law. Any vehicle traveling on any public road must have this cover so that in the event of an accident affecting a third party in any way, they are able to get compensation from the car owner's insurance company. This cover does not compensate for damage or loss of the car, or injury to or death of the car owner. In most cases, third-party claims are through a court of law where the third party or their representatives will identify and prove that the car owner is liable to pay the claim. The above is the definition of what third-party only cover means. However, the specifics are always outlined in the policy schedule. When you get your policy document, the schedule should be able to tell you the following. How much will your policy pay in a legal case when your car injures or kills another person? How much will your policy pay in a legal case when your car injures or kills several people? How much will your policy pay in a legal case when your car damages another person's property? How much will your policy pay in a legal case when your car injures or kills a passenger traveling in your vehicle? How much will your policy pay in a legal case when your car injures or kills several passengers traveling in your vehicle? In insurance writing, they are called limit of liabilities and they will appear as follows in your policy schedule. Third-party injury or death, limit payable when one person is injured and limit payable in one incident where many people are injured are given in form of a currency. Third-party property damage, limit per accident damaging one person's property or several properties is given in form of a currency. Passenger's injury or death, limit payable when one person is injured and limit payable in one incident where many people are injured are given in form of a currency. In Kenya, the basic statutory limits are as given below. Third-party injury or death. For one person the policy will pay up to Kenya shillings 3 million. For many people injured in one accident, the policy will pay up to Kenya shillings 20 million. Third-party property damage. The policy will pay up to Kenya shillings 5 million for damage to a property or properties in one accident. Passenger's injury or death. For one person the policy will pay up to Kenya shillings 3 million. For many people injured in one accident, the policy will pay up to Kenya shillings 20 million. The above illustration of limits are basic cover limits. Various insurance companies offer different limits of liabilities. For you as the car owner, the higher these limits of liabilities are, the better the cover. Please note that the courts are not bound by the limits in your policy. The judge can give the claimant an amount higher than your policy limit. If this happens, the insurance company will only pay up to the limit set out in the policy document and you are liable for any amount above the policy limit. However, there is a silver lining in court cases handled by the insurance company since they will always negotiate for the court awards to be within the policy limits. As mentioned in my video on motor claims procedures last week, it is of utmost importance to report every and all accidents to your insurance company. So, as you can clearly see, third-party covers may be cheap in costs, but what it saves you should anything happen is enormous. Paying 3 or 5 or 20 million out of pocket when an accident happens will literally make you bankrupt. That is why the state made this cover mandatory. Just ensure your cover is valid and has good limits. Other facts about third-party covers and claims. You cannot claim compensation from the other person's insurance directly as a third party since you are not a party to the contract. Any claim against an individual who hits you or your car or damages your property must be raised through the owner of the car by issuing a demand letter and/or court summons. In the same way, a third party cannot claim from your insurance company since they are not a party to your insurance contract. Your insurer or the third-party insurer will not pay a claim where the above claims processes such as issuing demand letter or court summons are not followed. So, do not go to someone's insurer to claim as a third party, or send a third party you hit on the road to claim from your insurer. The role of demand letter is to hold a person responsible for an accident and give an ultimatum for them to accept liability and pay within a stipulated time frame, failure of which, you are free to go to court. Bonus information. In Kenya, the insurance of motor vehicles is governed by an Act of Parliament known as the Motor Vehicle Third Party Risks Act, Cap 405, which stipulates various requirements, among them mandatory minimum insurance cover for all vehicles on public roads. This act further states that you must have and always display a valid insurance certificate on the left-hand side of your windscreen at all times. Having the certificate and not displaying it as stipulated attracts fines and even jail time.
My advice? Always display it. That's all for now. I will talk about comprehensive motor insurance covers in my next video. Subscribe and click on the notification bell so that you don't miss this and my other videos.
Hello people, I hope you are well. Our channel is growing and we thank you for the support. We will continue the good work as per your comments. There are some common avoidable mistakes that people always make when purchasing motor insurance. Let us talk about them and I will tell you how to avoid them. As usual, we have a tip for you at the end of the video. Stay tuned. We talked about buying a car as an investment in my earlier videos. Today, I am going to look at the biggest mistakes you are always making when purchasing insurance cover for your car. For you and for many people, Buying insurance starts with a call to your insurance company or insurance broker and asking about the rate they will give you, then ask what that rate covers, and you decide to purchase or not depending on whether you like the response or not. This is mistake number 1. Relying on other people to tell you how they will cover your car other than you designing your cover by stating how you want your car to be taken care of by insurance. To correct this, you need to tell the insurer what you want instead of letting the insurer sell you a cover which may not meet your needs. List all the services you want an insurance policy to give you. Then ask your broker or agent to look for a cover that matches your requirements. For example, when I am purchasing insurance, I want an insurance cover that will repair my car, pay me when the car is stolen or burnt, pay third parties when my car accidentally injures them or damages their property, give me courtesy car, pay for windscreen, side mirror and radio cassette when stolen, pay for my excess when the policy demands for it, and so on. The list is based on experiences that one has had in the past. After you arm yourself with what you want your insurance policy to do for you, then set and find a cover that responds to your needs. Mistake number 2, not giving insurance priority or not taking insurance seriously. A comprehensive insurance cover is like having another car similar to your car waiting for you, since the policy literally promises to give you another car in form of payment when yours is totally damaged or stolen. You spend a lot of time saving to purchase a car, then days looking for a good car, only to let someone else decide what is a good policy for your car. Getting a good motor insurance policy is like having savings account from which you get funds to repair or replace the car parts or replacing the whole car. The difference here is, when you purchase insurance, you only pay premium once a year and the insurance company will take care of all the major expenses within that year. Always ask about the policy. Read the policy document for yourself or go through it with your broker or agent, and be generally aware of your insurance policy, insurance renewal dates, and changes in legislation and regulations affecting insurance industry. You can either do that by yourself or have your broker or agent to assist. Mistake number 3 is not budgeting for insurance premiums. It is easier when buying a car for the first time, since one will plan ahead and know that insurance need an upfront payment of premiums. However, during subsequent renewals, for some people, premium is not a priority. Well, some insurance companies will allow you 2 installments within a month, but it is more prudent to prepare and pay your renewal premium once at renewal. It helps you avoid unnecessary hustles like when your car get an accident before you complete payment. Your insurance company can either choose to decline the claim or ask you to complete premium payment beforehand. The common critical mistake people make when purchasing insurance policy is failing to declare the correct use of the car. As mentioned in one of my earlier video, insurance risks vary with vehicle use and are rated based on what the car will be used for. Some will purchase private insurance policy and end up using the car for hire and reward, as in Uber, taxis, etc. If this happens and the car gets an accident, the claim will be rejected, and rightly so. Declare the correct use of the car and get correct cover. It is that simple. That is all for now. Look out for more of these mistakes in my upcoming videos. Today's tips. 1. Insuring 3 or more cars with one insurance company entitles you to a fleet discount. 2. You can get higher limits of extensions like higher windscreen or radio cassette or side mirrors limit at a small additional fee. 3. Having your car valued every year will ensure you get the right value coverage with discounted premium. Let's meet again in the next video.
Hello friends, welcome back once again. In today's video, let's talk about the application of insurance by the early African societies in their everyday life. Most of the recorded history of insurance are those from Europe and the Americas. What about Africa? Did our ancestors understand insurance? Did they practice it? These are questions whose answers either lie somewhere in the forgotten history books or are yet to be discovered. In my opinion, there are practices that would be considered as putting in place an insurance policy if we were to carefully scrutinize the intentions of these practices and compare them with the results they achieved. The first example is that of friendly families or societies. The early history of insurance talked about the existence of friendly or mutual societies. According to Britannica.com, these were societies that were formed voluntarily by individuals to protect their members by extending mutual assistance to them in circumstances of distress, such as during illness, death, or old age, which is the same as medical insurance for illnesses, life assurance for death, and pensions in old age. In early Kenyan societies, The family setup was closely knit, such as an extended family, with an unwritten rule that each family takes care of its own. When a nuclear family loses both parents, leaving behind a child or children, the society through the extended family call upon another family to take in the deceased's children as their own, thereby ensuring that the children left behind are taken care of as if the parents were alive. This was in some way a form of life assurance. Society ensured that the orphaned children were not left on their own. Of course, the stories being told about the experiences of the adopted orphans vary from good to bad to worse, compounded by modernization, moral turpitude, and societal challenges. However, the central point of these practices remains noble as set out by the ancestors. The second scenario is that found in African society's way of life. The synergetic nature of African society is what made two or more individuals pool their resources together and uplift each other economically. They even cooperated in the building of houses and tilling the land, taking care of the children, taking care of animals, also known as herding, and well as taking turns protecting each other from enemies at night. From this kind of organization, they also came together to assist one of their own when misfortune struck. When one loses a house through flood, fire, or any other calamity, they come together and contributed resources to rebuild the house. This is property insurance. Through pooling resources from many people to help one person who has suffered a misfortune, the member in question is returned back to the position he or she was in before fortune. This is precisely the role of insurance. Premium paid here was in form of a member being active in the society and also pooling resources for the next person. Another example is property ownership and protection. When we talk about property ownership and protection, one particular practice relating to livestock or domestic animals comes to my mind. There existed, and I would bet that it still does, a practice where a person who owned a large herd of cattle, goats, or chickens would take a few of his or her flock and give them to another family member or a friend who lived far away for them to take care of the deposited livestock to be collected back someday. In my local Luo dialect, we called this practice sending livestock to another. Other than the fact that this practice created space where there is crowding and ensure feeding grounds are not depleted, it also ensured that the livestock owner would be able to build back the herd or flock by recalling the deposited livestock after the loss of his herd or flock through calamities such as plagues or cattle rustling. This is property insurance, later developed as livestock insurance. This was an ingenious idea since through their own experience, they learned that plagues would affect one locality at a time. Therefore, this practice ensured that part of the herd or flock that is not in the affected locality was protected. And just like in insurance, the person temporarily taking care of the livestock would get to keep and use the livestock products, and as a rule, in some cases, they retain one offspring as a rule for his troubles. There are other practices like mixed cropping, planting two different types of crops, i.e. maize and beans, where one crop was meant to protect against failure of the main crop, thereby ensuring that the family still harvests some food for consumption. This is family income protection. I bet there is a policy for that in form of life assurance. These are a few examples of what I got from my research. However, this is a learning process, and I will definitely come back with more examples. Let me know in the comments below what you think about this article. Are there other examples we can add? Comment and let us know, and I will mention them in the next video. In the meantime, subscribe and click the notification bell to make sure you don't miss content like this.
Hello everyone, welcome once again. In this video, we will guide you step by step on how to report and document your claim to ensure it is settled to your satisfaction. Getting involved in a motor accident or losing a car through theft can be traumatizing, and for some, it is likely to even lead to depression. Claims documentation and processing is tedious and laborious. Dealing with the police and third parties is a horror. This is our third video on the motor vehicle insurance series. Today, we are looking at claims procedures under motor insurance. Towards the end of this video, I will give you a tip about motor accident claims to live by. It will save you a whole lot. Under motor vehicle insurance, there are many risks that may give rise to a loss resulting into a claim. The proximate cause and the type of the loss will determine procedures to be followed when a claim arises. Some of the circumstances giving rise to a motor vehicle claims are accidental collision with other vehicles, self-involving accident where no other vehicle is involved. An example is where a car hit a tree, landed in a ditch, or overturned, or any other type of accident where there is no other car involved. Total theft of the motor vehicle, fire damage to the vehicle through self-ignition, arson, or general fire, for example where a house was burning and the fire extends to the vehicle. Motor claims damage to windscreen or rear window and window glasses. Motor claims theft of or damage to side mirrors. Motor claims third-party liabilities. The first thing to do in an accident, whether minor or major where you are not injured, is to remain calm and composed. Secondly, secure your vehicle, as it is at this point that roadside observers also take advantage to steal personal belongings or even vehicle parts. Report and have the police investigate the accident scene and issue a police abstract report. Claims documentation and settlement procedures. Number 1. Motor accidents, both collisions and self-involving accidents. Report the accident to your insurer either directly if you are dealing directly with the insurer or through your intermediary if the cover was arranged through a broker or agent. Complete a claim form which will be provided by your insurer as accurately as possible and hand it over to the insurance company together with the police abstract report and a copy of driver's license. Take your vehicle to the garage for assessment and repair authorizations. Please note that insurance companies will have panel of garages they are working with. A copy of this panel will be provided to you to enable you select your preferred garage. Your insurer or intermediary can also offer guidance on a suitable garage. After you have taken the vehicle to the garage, insurers will assess the damage to the vehicle and authorize repairs. For private vehicles, you will get a courtesy car after the repairs have been authorized if your policy has the courtesy car extension. As the car is under repairs, the excess bit will come into play. Remember the excess definition we covered in our last video. Well, if you are not at fault in cases of collision accidents, no blame no excess clause will save you from paying the excess. If you are at fault or the accident was self-involving, then you will be required to pay the excess from your pocket or claim it from the excess protector policy, that is if your policy has that extension. After repairs, your vehicle will be released to you. Please note to carry out road tests and check the repairs thoroughly before signing the discharge form and driving away from the garage. In cases where it is uneconomical to repair the vehicle, it will be declared as a total loss or written off. Your insurer will give an offer and a discharge voucher to be executed by you and return to them together with a host of documents and items which will be listed in the offer letter, after which the claim will be paid. Please note the following. 1. Investigations may be carried out to weed out fraudulent claims in cases where a policyholder knowingly causes the accident in order to gain from the insurer's compensation. 2. When a vehicle, the salvage belongs to the insurer, and they will collect it before you get your compensation. The second type of motor claims is motor theft. Theft of motor vehicle can happen when the car is parked at home or in any public parking, and even by thieves commandeering the driver and stealing the car in his or her control. When this happens, just as in the same case with the accident, report the matter to the police immediately or as soon as possible. In cases where you were kidnapped or injured and you are not able to report immediately, obtain a police abstract report, then report to your insurer or intermediary. Complete a claim form and forward it to the insurer together with police abstract report and a copy of driver's license. Your insurer will carry out an investigation to ascertain some facts as well as work with the police in trying to trace the stolen vehicle as the investigation report is being prepared. Once the investigations have been finalized, insurers will make an offer and issue discharge voucher for you to execute and return together with a host of documentations and items which will be listed in the offer letter, after which the claim will be paid. Please note the following. 1. Investigations are carried out to weed out fraudulent claims in cases where a policyholder may organize for disappearance of the car to gain from the insurer. 2. After you are paid, the car belongs to the insurer and if found, should be taken to them. Number 3. Fire damage claims. When your car burns down either as a result of self-ignition or arson by third party or generally fire spreading from other sources, you are eligible to claim and get compensation. As it is with other claims mentioned before, report the matter to the police immediately or as soon as possible in cases where there are injuries that makes you not able to report immediately. Complete a claim form and forward it to the insurer together with police abstract report and a copy of driver's license. Your insurer will carry out an investigations to ascertain the cause of that fire and prepare a report. Once the investigations have been finalized, insurers will make an offer and issue discharge voucher for you to execute and return together with a host of documentations which will be listed in the offer letter, after which the claim will be paid. Please note the following. 1. Investigations are carried out to weed out fraudulent claims in cases where a policyholder starts a fire in order to gain from the insurer's compensation. 2. The salvage belongs to the insurer and they will collect it before you get your compensation. Number 4. Third-party liability claims. Third-party claims arises in cases where your car hits another person, or another person's car, or any other property including houses, fences, etc., and where a passenger was injured while traveling in your car. Third parties can, and in most cases will sue you as the owner of the car for damages arising from injuries, death, or your car having damaged their property. The start of these legal cases is when you receive a demand letter from their lawyer. When this happens, do not respond to the letter but instead, forward it to the insurer for immediate action. Insurers will acknowledge it and appoint a lawyer to handle the matter on your behalf. At this point, a third-party claim will have been registered by the insurer and you will be required to pay third-party excesses per your policy. We will do an episode on third-party excesses later. The demand letter will be followed by summons. Forward this to the insurance company, and they will handle everything from this to attend court from time to time. But that is it. Number 5. Replacement of damaged or stolen motor vehicle parts such as windscreens, radio cassette and side mirrors. These are simple claims whose processes take little time. For windscreen claim, report to your insurer or your intermediary, take a photo of the damaged windscreen, fill in a claim form and send both the photo and claim form to the insurer. They will issue an LPO and send you to a dealer in their panel to have the windscreen replaced. Insurer may also ask you to replace and forward the receipts for reimbursements. For radio cassette and side mirrors, report to your insurer or your intermediary, take photos showing the damages, fill in a claim form and send both the photo and claim form to the insurer. The insurer will either ask you to replace and forward the receipts for reimbursement or issue an LPO for replacement. Important notice, the above procedures will work smoothly in cases where you have purchased the correct policy, your policy is valid, the claim is not fraudulent, and premium payment is up to date. And now, to my tip on motor accidents, ensure that you report all accidents to your insurer regardless of whether it was major, minor or just a scratch. In these era full of ambulance chasers, you will most likely get a legal notice or an intention to sue letter in cases where you thought the third parties you hit or scratched their cars were friendly. We sure would like to learn a thing or two from your experiences. Leave us a note on the comments section below.
Your home, plus the items you have in your house, are probably your best investment and the most important and cherished assets of your family. Just imagine what would happen if they were destroyed by any risk and you lose everything. A domestic package policy provides cover to individuals, both homeowners and tenants, against risks that may affect their properties and their private dwellings. Hello and welcome to today's topic. We have an interesting tip at the end of this video. Subscribe and stay tuned. Domestic package policy, or homeowner's policy as it may be referred to in some instances, is a type of all risks insurance policy which covers a residential house and its contents against losses arising from various risks such as fire, theft or burglary, accidental damage, and even legal liability against the homeowner or tenant. The domestic package policy has been designed to meet home insurance needs and is divided into the following sections in order to better cater to individual needs. Section A, Buildings. Section B, Household Contents. Section C, All Risks. Section D, Work Injury Benefit. Sections E and F, Occupiers or Owner's Liability. Let us look at what is covered in each section. Section A, Buildings. This section covers buildings, that is, the main house and other surrounding houses such as servant quarters and gatehouse, perimeter fence, pools, car shades, gazebos, etc. Risks covered here include fire, earthquake, flooding, damage from impact, storm and hurricanes, damage of building following burglary or break-in, etc. What you can claim from this section. Damage to the buildings or parts of the building as defined in the section title. The policy will pay for the cost of repairs or rebuild up to the insured amount. Section B. Contents. This section covers household contents like furniture, beddings, cutleries, curtains, etc. Risks covered here include fire, earthquake, flooding, damage from impact, burglary, break-in, items falling and getting damaged, etc. What you can claim from this section. Damage or theft of any insured house contents damaged or stolen while inside the house. The policy will pay for the replacement of the damaged items via check or EFT. Section C. All risks. This section is dedicated to covering items that are movable from the house, like laptops, cell phones, clothes, and travel luggage, etc. Risks covered here include fire, earthquake, flooding, damage from impact, damage of building following burglary, break-in, theft while the items are outside the house and items falling and getting damaged, etc. What you can claim from this section. Damage or theft of any insured content. The policy will pay for the replacement of the damaged items via check or EFT. Section D. Domestic Servants Injury Cover. This section covers domestic servants against accidental injuries while in your employment. Benefits here are derived from work injury benefits policy. Section E. Legal liability by your domestic servant. This section covers you when your servant holds you liable in a court of law for injuries while working for you. Section F. Owners or occupiers liability cover. This section protects you, as the homeowner or tenant, against legal costs that you may incur in case any member of the public gets injured while in your house, or any item from your house injures the public or damages their property, including injuries from pets if the policy has a strict liability clause. How to purchase a good domestic package policy. List all the items you want to have insured and their prices. Note to also indicate how many servants you have. Once you give the list to your insurance company or intermediary, they will give you a quotation of how much premium you will be required to pay for the cover. When you receive the quotation, look out for the following. 1. Premium. Premium should be reasonable. The domestic package is relatively low risk cover, especially on buildings and the contents section. 2. Excesses. The excess applicable should be relatively low so that the cover is useful, especially when covering low-valued items. Ideal excesses to be applied to the domestic package are nil excess for buildings, excess of up to 10% of item value for in contents and all risk sections. Some policies will also have an excess specifically for cell phones and laptops. This is because their risks are relatively higher. Three, owners or tenants' liability. As stated previously, this section protects against legal liability due to injuries caused to the public while on your premises or damage to their properties, as discussed earlier. A good policy is one that gives higher limits of liability. Most of domestic package policies offer free limit up to 2 million shillings. There are other policies that will give you free limits up to 5 million shillings. Limits under this section can be enhanced at an additional premium. Domestic package policy schedule. When you purchase the cover and receive a policy document, the schedule of your document should look like this, or at least contain all items as listed here. Claims processes and procedures under domestic package policy. Claims process when claiming for damaged property. Report to your insurance company or broker. Fill in the claim form and provide required documents together with the salvage. Sign the discharge voucher and send to insurer to get paid. Claims process when claiming for stolen property under burglary or theft. Report to the police, obtain a police abstract, and then report the claim to your insurance company or broker. Fill in the claim form and provide required documents. Sign the discharge voucher provided and send to insurer to get paid. Points worth noting under this policy. Point number 1. All theft claims must be accompanied by a police abstract. Point number 2. Damage claims must be accompanied by photos of the damaged house or salvage in cases where one is claiming for phones, laptops, TVs, etc. Point number 3. The sum insured must be the current market value or current replacement cost less reasonable deduction for wear and tear and age. Point number 4. Under the policy, no single article is deemed to be worth more than 5% of the total sum insured unless such article is specifically insured. Point number 5. It is advisable to submit a list of all the items insured under the contents and all risk section, including their values. Point number 6. The total value of all jewelry and valuables will be deemed not to exceed 1/3 of the total sum insured unless the value of jewelry and valuables is separately declared. Point. The cover under the contents section ceases if the building is left unoccupied for more than 7 consecutive days. You should advise the insurance company prior to leaving the house for longer than 7 days in order to have the cover extended to cover unoccupancy risks. Some of the basic excluded risks under this policy are war, civil commotion, wear and tear, depreciation, damage due to moth, damage by process of repairing, restoring, or renovating. We have come to the end of this video. I hope that it has given you some insights onto a domestic package policy. Let us know your experience in the comment section below. Would you like us to arrange for you a domestic package or any other insurance policy? If so, please contact us via email or telephone number given in the description. Don't forget to subscribe. What is an agreed value clause in motor insurance? And why is it important for you? An agreed value clause is a clause that ensures that the sum insured or the value of the property declared at the time of purchasing insurance cover will remain valid up to the end of the policy period. This is important in motor vehicle and property insurance policies where the insured property is prone to depreciation, such as motor vehicles, machinery, computers, TVs, etc. It helps you, as the policyholder, know how much you will get paid by the insurance company in case of a loss from the beginning of a cover. The opposite of this clause is the market value clause, which provides that a policy will compensate for loss of an item based on the market value at the time of loss, which in most cases is less than the insured amount because of the depreciation element. Subscribe, click the notification bell, and let's meet again in the next video, soon. Feel free to share a comment.
Hello friends, how is your day today? We are pumped up and are very excited about your continued support. The channel is well on its way to making it big, courtesy of you, our viewer. In the world of insurance, there are 6 basic principles or forms of insurance coverage that must be fulfilled, including utmost good faith, insurable interest, indemnity, proximate cause, subrogation, and contribution. Today, let's begin these lessons by looking at proximate cause. What is proximate cause principle as applied in insurance? Proximate cause is defined as an active cause that is efficient in causing or setting in motion a chain of events that ultimately results into a loss, damage, or injury, without which the loss would not have occurred. It can either be the first or the last cause in that chain, but it is defined as the cause that is most active in bringing forth a result. The proximate cause principle in insurance refers to the idea that the cause of a loss must be the proximate, or closest, cause in order for the loss to be covered under an insurance policy. In other words, the insurance company will only cover a loss if the cause of that loss is the event or factor that will set in motion the chain of events leading to the loss. For a proximate cause to be critical in deciding whether the loss is covered or not, the following must exist. There must be a loss of or damage to an insured property. There must have been a chain of or series of several events leading up to the loss of that particular property. Property must have been insured against one or more, but not all causes of a loss. What to look at when investigating proximate cause. 1. Directness. The cause must have a direct and immediate effect on the loss. The closer the relationship between the cause and the loss, the more likely it will be considered the proximate cause. 2. Predominance. The cause must have been the primary and dominant factor in bringing about the loss. If multiple causes contribute to a loss, the one that had the most significant effect will typically be considered the proximate cause. 3. Reasonableness. The cause must have been foreseeable. In other words, it must have been reasonable to expect that the event could occur and result in the loss. 4. Intervening causes. Intervening causes are events that occur between the initial cause and the loss, and they can affect whether the original cause is considered the proximate cause. If an intervening cause is not foreseeable, it may break the chain of causality and make the original cause no longer the proximate cause. 5. Policy exclusions. The terms and conditions of the insurance policy, including any exclusions, will also be considered in determining the proximate cause. If a policy specifically excludes coverage for a certain type of loss, that loss will not be covered even if it is the proximate cause. Examples of scenarios where this principle will apply. Example 1. If a tree falls on a house and causes damage, the proximate cause of the damage would be the falling tree. If, however, an examination of the tree reveals that it was rotten and diseased, and that this was the true cause of the tree falling, the insurance company may not cover the loss because the proximate cause was not the falling tree, but the tree's prior condition. Example 2. If a house burns down due to a lightning strike, the lightning strike would likely be considered the proximate cause of the loss, and the insurance company would provide coverage. However, if the house burns down due to a faulty electrical system, the faulty electrical system would likely be considered the proximate cause of the loss, and the insurance company may deny coverage if the policy specifically excludes coverage for losses caused by faulty electrical systems. Example 3. Fire loss. If a fire occurs in a building, the proximate cause of the loss would be the event that directly caused the fire, such as a short circuit in the wiring or a cigarette. Example 4. Flood loss. If a flood occurs in a home, the proximate cause of the loss would be the event that directly caused the flood, such as a heavy rainfall or a broken dam. Example 5. Earthquake loss. If an earthquake causes damage to a building, the proximate cause of the loss would be the earthquake itself. Example 5. Car accident loss. If a car accident occurs, the proximate cause of the loss would be the event that directly caused the accident, such as a driver running a red light or losing control of the vehicle. Example 6. Business interruption loss. If a business experiences a loss of income due to a natural disaster or other event, the proximate cause of the loss would be the event that directly caused the interruption, such as a hurricane or a fire in the building. Example 7. Property damage. If a tree on your neighbor's property falls and damages your home, proximate cause would be used to determine whether the neighbor's failure to remove the dead tree was the proximate cause of the damage to your home. Example 8. Personal injury. If you are injured in a car accident caused by another driver who was under the influence of drugs or alcohol, proximate cause would be used to determine whether the driver's actions were the proximate cause of your injury. Example 9. Business interruption. If a fire in a neighboring building causes your business to shut down for several days, proximate cause would be used to determine whether the fire was the proximate cause of your business interruption. Example 10. Product liability. If a faulty product causes injury to a consumer, proximate cause would be used to determine whether the manufacturer's failure to adequately test or warn about the product was the proximate cause of the injury. The proximate cause principle helps insurance companies determine whether a loss is covered under an insurance policy, and can also help policyholders understand what types of losses are eligible for coverage. Let's meet tomorrow and look at another one of these principles. If this video provided you with some knowledge, please subscribe, like and share our videos. That is the only support we are asking for.
Good day from wherever you are. We are glad you could join us on this day. We're talking about insurable interest as one of the principles of insurance. Definition of insurable interests. Insurable interest is a legal concept in insurance that refers to the relationship between the insured and the subject matter of the insurance policy. It requires that the person buying insurance prove ownership and that they have a financial or fiduciary interest in the property, event, or significant reason for wanting to protect the property or person, and must stand to suffer a financial loss in the event of its destruction or death. For example, a homeowner has an insurable interest in their home because they have spent their money building or purchasing the property and would suffer a financial loss if the home was damaged or destroyed. The owner of a car also spent money to buy his or her car, therefore stand to lose when it is damaged or stolen. How about inherited properties? Can you legally insure them? When one inherits a property, he or she assumes the ownership, care, maintenance, and use of the property and therefore have a legal right to insure the same as their own. When you inherit a car, you also inherit its financial value and therefore you stand to lose financially when they are damaged or stolen. The same applies to any other property whose value can be quantified in financial terms. Insurable interest is a requirement for obtaining insurance coverage and ensures that the person seeking insurance has a valid reason for insuring the property or life and will not profit from its destruction or loss. This principle is an important principle in insurance because it helps to prevent people from taking out insurance policies for illegitimate or fraudulent purposes, such as trying to insure something that they do not have a legitimate interest in or attempting to profit from the destruction of property. Insurable interest requirement for purchasing insurance cover. An insurable interest means that the person insured has an ownership interest. 1. Property insurance. In property insurance, insurable interest is established when the person insured has an ownership interest in the property or a financial relationship with it, such as a mortgage or a lease. This means that the person insured has a stake in the continued existence or preservation of the property and will suffer a financial loss if the property is destroyed or damaged. 2. Life assurance. In life assurance, an insurable interest is established when the person insured has a close relationship with the person whose life is being insured. This means that the person insured would suffer a financial loss if the person whose life is being insured were to die. For example, a spouse, parent, or business partner would have an insurable interest in the life of their spouse, child, or business partner. 3. Health insurance. In health insurance, insurable interest is established when the person insured has a financial relationship with the person whose health is being insured. This means that the person insured would suffer a financial loss if the person whose health is being insured were to become ill or require medical treatment. For example, an employer would have an insurable interest in the health of its employees. 4. Casualty insurance. In casualty insurance, insurable interest is established when the person insured has a relationship with the property or the person whose loss is being insured. This means that the person insured would suffer a financial loss if the property or person were to become damaged or destroyed. For example, an owner of a car would have an insurable interest in the car, and a business owner would have an insurable interest in their employees. 5. Financial or contractual relationships. A financial relationship with the property being insured, such as a mortgage or a lease. In instances where the bank loans you money to build a house or buy a car, the bank has a financial interest in the house or car and therefore they have a right to insure the car or the house in your name and their name jointly. This kind of relationship also applies to a lender-borrower relationship, such as when a lender takes out a life insurance policy on the life of a borrower to secure a loan. Many of you who have taken out loans with banks or SACCOs have noted an insurance charge levied on your loan. This charge is the insurance cover that the bank has purchased covering your life to protect the amount they loaned you. 7. Marine insurance. Insurable interest refers to the financial interest that an insured party has in the subject matter of the insurance policy. For example, a ship owner has an insurable interest in the ship they own, while a cargo owner has an insurable interest in the goods they are shipping. The principle of insurable interest is fundamental to marine insurance and is a requirement for a valid insurance contract. It ensures that the insured party has a legitimate stake in the subject matter of the insurance policy and is motivated to take steps to protect it. This helps to prevent fraud and encourages prudent risk management. In marine insurance, the insurable interest can be established in several ways. For example, an owner of a ship has an insurable interest in the vessel, while a charterer of a ship has an insurable interest in the goods they are transporting. Similarly, a cargo owner has an insurable interest in the goods they are shipping, while a shipper has an insurable interest in the safe and timely delivery of the goods. It is important to note that insurable interest must exist at the time the policy is taken out and must continue to exist for the duration of the policy. If the insurable interest no longer exists, for example, if the ship is sold or the goods are delivered, the insurance coverage may be canceled or reduced. 8. Life assurance. In life assurance, insurable interest refers to the financial interest that an insured party has in the life of the insured person. In other words, it is the relationship between the insured and the policyholder, and the financial loss that the policyholder would incur in the event of the insured person's death. For a life insurance policy to be valid, the policyholder must have an insurable interest in the life of the insured person at the time the policy is taken out. This requirement helps to prevent fraud, as it ensures that the policyholder is not taking out a policy on someone's life for malicious or speculative reasons. Examples of insurable interest in life assurance include: a husband has an insurable interest in the life of his wife, as he would suffer a financial loss in the event of her death. A parent has an insurable interest in the life of their child, as their death would cause emotional and financial distress. A business owner has an insurable interest in the life of a key employee, as their death would result in a financial loss for the company. Overall, the concept of insurable interest is an important requirement for insurance coverage and helps prevent fraud and abuse in the insurance industry. On the other hand, someone who does not own a property or have any financial stake in it, such as a stranger, does not have an insurable interest in the property and cannot take out an insurance policy on it. It ensures that insurance policies are not taken out solely for the purpose of profiting from a loss. The next video will be in utmost good faith. Subscribe and click on the notification bell so that you do not miss this and many more. Thank you for watching. Good morning or good day, my friends. Sorry, I was away for the last 2 days attending to something. We are back. Today, we take a look at the principle of indemnity. Indemnity is a principle of insurance that guarantees to restore the insured to the same financial position they were in before the occurrence of the insured loss or damage. In other words, indemnity in insurance means compensating the insured for the actual loss they have suffered, but not exceeding the amount of the loss. Under the principle of indemnity, the insured is not allowed to make a profit from the insurance policy. The aim of the indemnity principle is to put the insured back in the same financial position they were in before the loss occurred. The insurer's obligation is limited to the amount of the loss or damage incurred, and it should not exceed the amount of the policy. For example, if a homeowner's house is damaged due to a covered event, the insurer will provide compensation for the actual amount of damage suffered by the homeowner, but not more. The insured cannot make a profit from the insurance payment. Rather, the aim is to restore them to the financial position they were in before the loss occurred. The principle of indemnity is applied in insurance to ensure that the insured party is restored to their financial position before the occurrence of the insured loss or damage. The application of indemnity in insurance involves several key principles, including: 1. the insurer's liability is limited to the amount of the loss or damage suffered by the insured. In other words, the insurer is not required to pay more than the actual loss or damage. 2. The insured must provide evidence of the loss or damage and its value. This ensures that the insurer can determine the extent of the loss and provide compensation accordingly. 3. The insured cannot make a profit from the insurance payment. The aim of the indemnity principle is to restore the insured to their pre-loss financial position, not to provide them with a windfall. 4. The insurance policy will generally specify the maximum amount that the insurer will pay in the event of a loss, known as the policy limit. 5. The insurer may choose to repair or replace the damaged property instead of providing a cash payment to the insured. 6. The insured may be required to pay a deductible or excess before the insurer provides compensation. Overall, the application of the indemnity principle in insurance aims to ensure that the insured is fairly compensated for their loss or damage, while also preventing them from profiting from the insurance policy. The principle of indemnity can be abused in insurance in a few ways, including 1. Overinsurance. Overinsurance occurs when an insured party takes out an insurance policy for an amount that is higher than the actual value of the property being insured. This can result in the insured receiving a payout that is greater than the actual value of the property, which goes against the principle of indemnity. 2. Underreporting the value of the loss or damage. If the insured party underreports the value of the loss or damage, they may be able to receive a larger payout than they are entitled to under the principle of indemnity. 3. Fraudulent claims. If the insured party submits a fraudulent claim, they may receive a payout that exceeds the actual value of the loss or damage, which goes against the principle of indemnity. 4. Insuring a property for more than one policy. An insured party can take out multiple insurance policies on the same property, which is known as double insurance. This can result in the insured receiving a payout that is greater than the actual value of the property, which goes against the property for less than its actual value. This can result in the insured not being adequately compensated for their loss or damage, which goes against the principle of indemnity. It is important to note that any abuse of the principle of indemnity in insurance is considered fraudulent and can have serious legal and financial consequences. While the principle of indemnity is a fundamental principle in most types of insurance policies, these are often referred to as non-indemnity policies. Some examples of non-indemnity policies include 1. Life insurance policies. Life insurance policies are designed to provide a set amount of money to the beneficiary upon the death of the insured. The payout is not tied to any specific loss or damage, and therefore the principal of one's life. 2. Personal accident insurance. Personal accident insurance policies provide a set payout in the event of the insured's death or permanent disability resulting from an accident. The payout is not tied to any specific loss or damage, and therefore the principle of indemnity does not apply. Another reason for this is that you cannot tie the loss of a limb to a specific amount. 3. Travel insurance policies. Travel insurance policies may provide coverage for a range of events, including trip cancellation, medical emergencies, and lost baggage. The payouts are often based on predetermined amounts, and therefore the principle of indemnity may not always apply. Travel accident claims under trip cancellation and accidental injuries cannot be quantified in financial terms, hence a limit is preset when purchasing the policy, just to avoid back and forth as to how much one's time, lost limb is worth. 4. Liability insurance policies. Liability insurance policies are to protect the insured from claims made against them by third parties. The payouts are often based on the amount of damages awarded to the third party by a court of law and any other mandated tribunal body, and therefore the principle of indemnity may not always apply. It is important to note that even in non-indemnity policies, the payouts are generally limited to the amount specified in the policy and are subject to various terms and conditions. This is the end of this particular topic. What do you think about this principle? How about the other three we have covered already? Please, let us have your comments or suggestions on them. Also, take time to watch our other videos. Have you subscribed? If not, please do so now and watch out for the next video soon. Hello viewers and listeners. I trust you are well today. Ever heard of the principle of loss minimization in insurance? In the context of insurance, the principle of loss minimization is an important concept that insurers use to determine how much to charge for a policy. The principle states that the premium charged for an insurance policy should be sufficient to cover the expected losses incurred by the insurer, along with administrative expenses and a profit margin. To determine the appropriate premium for a policy, insurers use actuarial analysis to estimate the likelihood and potential cost of various types of losses that the insured party may experience. This analysis takes into account factors such as the insured party's risk profile, the type of policy being sold, and the historical data on similar claims. Based on this analysis, the insurer will set a premium that is high enough to cover the expected losses and expenses associated with the policy. The premium is typically adjusted based on the level of risk posed by the policyholder, with higher risk individuals or groups being charged higher premiums to account for their increased likelihood of experiencing a loss. The principle of loss minimization is essential in the insurance industry because it helps to ensure that insurers are able to cover the cost of claims and remain financially stable over the long term. By accurately pricing policies based on the expected losses, insurers can provide coverage that is both affordable for policyholders and sustainable for the company. How loss minimization principle is applied in insurance? The principle of loss minimization is a fundamental concept in the insurance industry. It applies in several ways to ensure that insurers can effectively manage risk, set appropriate premiums, and provide coverage to policyholders. Here are some ways in which the principle of loss minimization applies in insurance. Underwriting. When an insurer underwrites a policy, it assesses the level of risk posed by the policyholder and the likelihood and potential cost of various types of losses. This analysis helps the insurer to determine the appropriate premium to charge for the policy based on the principle of loss minimization. The insurer must charge a premium that is high enough to cover the expected losses and expenses associated with the policy, while also remaining affordable for the policyholder. Risk management. Insurers use risk management techniques to minimize the likelihood and potential cost of losses. For example, insurers may require policyholders to take certain precautions to reduce the risk of loss, such as installing fire alarms or sprinkler systems. By reducing the likelihood of loss, insurers can minimize the expected losses associated with a policy and provide coverage at a lower cost. Claims management. When a policyholder experiences a loss, the insurer's claims management process is designed to minimize the cost of the claim while providing appropriate compensation to the policyholder. Insurers use a variety of techniques to investigate and assess claims, such as adjusters, appraisers, and medical professionals. By accurately assessing the cost of a claim, insurers can minimize the loss associated with the policy and remain financially stable over the long term. Factors that can hinder effective application of the principle of loss minimization in insurance. While the principle of loss minimization is a key concept in the insurance industry, there are several factors that can hinder its effective application. Here are some of the factors that can impact the effectiveness of the principle of loss minimization in insurance. Inaccurate data. Insurers rely on data to assess the level of risk associated with a policy and estimate the expected losses. If the data is inaccurate, incomplete, or out of date, insurers may set premiums that are too high or too low, which can result in financial losses or make coverage unaffordable for policyholders. Unforeseeable risks. Some types of losses, such as natural disasters or major technological disruptions, are difficult to predict and may result in unexpected financial losses for insurers. In these cases, the principle of loss minimization may not be effective in managing the risk associated with these events. Fraud. Insurance fraud is a significant problem for insurers, particularly in areas such as health insurance and workers' compensation. Fraudulent claims can result in significant financial losses for insurers, which can impact the effectiveness of the principle of loss minimization. Regulatory constraints. Insurers are subject to a variety of regulations and requirements that can impact their ability to apply the principle of loss minimization effectively. For example, regulators may require insurers to offer coverage to high-risk individuals or limit the premiums that can be charged for certain types of policies. Competitive pressures. In a competitive market, insurers may be pressured to lower premiums or offer coverage to riskier policyholders to remain competitive. This can result in a situation where the premiums charged are insufficient to cover the expected losses, which can impact the financial stability of the insurer over the long term. How insurers and policyholders can work together to achieve loss minimization. Insurers and policyholders have a shared interest in achieving the principle of loss minimization in insurance. Both parties benefit from policies that are priced fairly and provide appropriate coverage, while also minimizing the potential for financial losses. Here are some ways in which insurers and policyholders can work together to achieve the principle of loss minimization. Risk management. Policyholders can take steps to reduce the likelihood and potential cost of losses. For example, a homeowner might install a security system or a driver might take a defensive driving course. By taking these precautions, policyholders can reduce the risk associated with a policy and potentially lower the cost of the premiums charged by the insurer. Policyholders must provide accurate and complete information when applying for insurance policies. This information helps insurers to accurately assess the level of risk associated with a policy and set appropriate premiums. If policyholders provide inaccurate or incomplete information, the premiums charged may be insufficient to cover the expected losses, which can impact the financial stability of the insurer over the long term. Claims management. Insurers and policyholders must work together to ensure that claims are processed accurately and efficiently. Policyholders should provide complete and accurate information when filing a claim, and insurers should investigate claims promptly and thoroughly to ensure that the cost of the claim is accurately assessed. By working together to manage claims, insurers and policyholders can minimize the potential for financial losses associated with a policy. Collaboration. Insurers and policyholders can work together to identify and mitigate risks associated with a policy. For example, an insurer might offer policyholders advice on risk management techniques or provide resources to help policyholders reduce the likelihood of loss. By collaborating to manage risk, insurers and policyholders can achieve the principle of loss minimization in a more effective and efficient way. Overall, achieving the principle of loss minimization requires collaboration and shared responsibility between insurers and policyholders. By working together to manage risk, provide accurate information, and process claims efficiently, insurers and policyholders can achieve the principle of loss minimization in a way that benefits both parties. Thank you for your time. We know you have subscribed, right? Hello to you, our listeners and viewers, or as we say on this side of the world, my friends. We are almost done with this topic on principles of insurance. Another one of the principles of insurance is subrogation, which we are looking at today. Definition and illustration of the subrogation principle. The principle of subrogation, in simple illustration, refers to the right of an insurer to step into the shoes of an insured after paying a claim and to pursue any legal rights or remedies that the insured may have against a third party who caused the loss. In other words, subrogation allows the insurer to seek reimbursement from the responsible party for the amount it paid out to the insured. In insurance, subrogation is a principle that allows an insurer to take legal action against a third party who is responsible for causing an insured loss or damage, in order to recover the amount of money the insurer paid to the insured for the loss or damage. An example: If a driver is involved in an accident and the insurer pays for the damages, the insurer may then pursue the driver who was at fault or their insurance company for reimbursement of the amount paid out to the insured driver. This helps to ensure that the responsible party ultimately bears the financial burden of their actions, rather than the insurer or the insured party. The subrogation principle is often included in insurance policies and is intended to prevent a double recovery of the same loss. It is an important tool for insurers to help reduce their losses and keep insurance rates affordable for consumers. Why the subrogation principle is important. The subrogation principle is an important concept in insurance for several reasons. 1. Protecting the insurer's interests. Subrogation allows insurers to protect their interests by recovering the money they paid out to an insured in the event of a loss. This helps to prevent insurers from bearing the entire cost of the loss and helps to maintain the financial stability of the insurance industry. 2. Encouraging responsible behavior. Subrogation can encourage responsible behavior among insureds by promoting the idea that they should not be rewarded for losses caused by others. If an insured is not responsible for a loss, then the subrogation principle allows the insurer to recover the money from the responsible party, rather than the insurer itself. 3. Lowering insurance premiums. The ability to recover losses through subrogation can help to reduce the amount of claims that insurers pay out. This can help to keep insurance premiums lower for everyone, as insurers can pass on the savings to their customers. 4. Encouraging safety. Subrogation can encourage safety measures, such as better driving practices, because it helps to shift the financial responsibility for losses to those who caused them. This can incentivize individuals and businesses to take steps to reduce their risk of causing losses that could trigger subrogation. Examples or circumstances where subrogation can be applied. Here are a few examples of how the subrogation principle can be applied in insurance. 1. Auto insurance. If an insured driver is in a car accident caused by another driver, and the insured's car is damaged or destroyed, the insured's auto insurance company may pay for the damages or provide a replacement vehicle. The insurer may then use subrogation to recover the money it paid out from the at-fault driver's insurance company. 2. Property insurance. If an insured's property is damaged by a third party, such as a neighbor's tree falling onto the insured's house, the insured's property insurance company may pay for the damages. The insurer may then use subrogation to recover the money it paid out from the neighbor's homeowner's insurance company. 3. Workers' compensation insurance. If an employee is injured on the job and receives workers' compensation benefits from their employer's insurance company, the insurer may use subrogation to recover the money it paid out from a third party that caused the employee's injury, such as a manufacturer of faulty equipment. 4. Health insurance. If an insured person is injured in an accident caused by a third party, such as a car accident or slip and fall, their health insurance company may pay for their medical expenses. The insurer may then use subrogation to recover the money it paid out from the at-fault party's insurance company or from a lawsuit settlement or judgment. Factors affecting the successful application of the subrogation principle. While the subrogation principle can be an effective tool for insurers to recover losses and maintain financial stability, there are several challenges that insurers may face when applying subrogation. Here are a few examples. 1. Legal complexity. Subrogation can be a legally complex process, as insurers must navigate a variety of laws, as well as court decisions when pursuing subrogation claims. 2. Costly and time-consuming. Subrogation can be a costly and time-consuming process, particularly in cases where the insurer must pursue a legal claim against a third party. This can create an administrative burden for insurers and can result in higher costs for the insured. 3. Difficulty proving liability. Insurers may face challenges in proving liability on the part of a third party, particularly if the circumstances surrounding the loss are unclear or if there is a dispute about who is at fault. 4. Settlement offers. In some cases, a third-party insurer or defendant may offer a settlement that is less than the amount the insurer paid to the insured. Insurers may need to make a judgment call about whether to accept the settlement or continue pursuing the subrogation claim in court. 5. Insured cooperation. In order to pursue subrogation, insurers may require the cooperation of the insured, particularly in cases where the insured's testimony or evidence is critical to the success of the subrogation claim. However, insureds may be unwilling or unable to cooperate for a variety of reasons. How the policyholder and insurer can cooperate to achieve subrogation. There are several ways that the insured and the insurer can work together to facilitate subrogation and increase the chances of a successful recovery. Here are a few examples. 1. Prompt reporting. Insured should promptly report. This can help. Insured should take steps to preserve any evidence related to the loss, such as photographs, witness statements, and physical evidence. This can help the insurer to build a strong case for subrogation and can increase the chances of a successful recovery. 3. Cooperation with the insurer. Insured should cooperate with their insurer during the subrogation process, providing any information or assistance that the insurer may require. This can include providing testimony, attending depositions or court hearings, and responding to requests for information. 4. Recovery agreements. In some cases, insurers and insureds may enter into a recovery agreement where the insured agrees to help the insurer pursue subrogation in exchange for a portion of any recovery. This can incentivize insureds to be more active in the subrogation process and can increase the chances of a successful recovery. 5. Communication. Insureds and insurers should maintain open lines of communication throughout the subrogation process, keeping each other updated on any developments and discussing any issues or concerns that may arise. By working together, insureds and insurers can increase the chances of a successful subrogation recovery. Prompt reporting, preservation of evidence, cooperation, recovery agreements, and communication are all key factors in facilitating subrogation and maximizing recovery potential. In conclusion, the subrogation principle plays an important role in maintaining the financial stability of the insurance industry, promoting responsible behavior, lowering insurance premiums, and encouraging safety measures. Thank you for watching. We are very happy to have been of service. However, we have noted that most of you are watching without subscribing. Please subscribe, like, and comment. We will see you in another video soon. We are here again to define and explain utmost good faith principle. By the way, we trust that the 2 previous videos on the principles of insurance have given you some insights. Raise your hands and nod your head if they did. Oh, wait. We can't see you. Just like the video and leave a comment. We will acknowledge and respond. Now, on to this video's lesson. Utmost good faith. The principle of utmost good faith, also known as the duty of utmost good faith, is a fundamental principle in insurance law that requires all parties involved in an insurance contract to act in good faith and with complete honesty towards each other. This means that both the insurer and the insured have a duty to disclose all relevant information truthfully and completely to the best of their knowledge in order to enable the insurer to assess the risk and determine the premium to be charged. The principle of utmost good faith is a mutual obligation that applies throughout the entire duration of the insurance contract. It is a key component of insurance contracts and is based on the idea that insurance is a relationship of trust between the insurer and the insured. The principle is considered a feature of insurance contracts and is reflected in various aspects of insurance law, including underwriting practices, claim handling procedures, and policy interpretation. The principle of utmost good faith is applied in various aspects of insurance, including the following. 1. Underwriting. Before an insurance contract is entered into, the insurer must assess the risk and determine the premium to be charged. The insured is required to disclose all relevant information about the risk being insured, including the nature of the property or liability being insured, any prior claims or losses, and any other relevant factors. 2. Claims handling. In the event of a loss, The insured has a duty to report the claim promptly and to provide all relevant information to the insurer in order to allow the insurer to assess the claim and determine the extent of its liability. 3. Policy interpretation. The principle of utmost good faith applies when interpreting the terms and conditions of an insurance policy. The insurer is required to act in good faith in interpreting the policy, and the insured is required to act in good faith in fulfilling its obligations under the policy. 4. Renewal of policy. When renewing an insurance policy, the principle of utmost good faith requires both the insurer and the insured to act in good faith and to disclose any changes to the risk or any other relevant information that may affect the assessment of the risk. A breach of the principle of utmost good faith can occur in various scenarios, including the following. 1. Material misrepresentation. If the insured makes a false or misleading statement on the insurance application, such as concealing a prior claim or providing incorrect information about the risk being insured, this may be considered a breach of the principle of utmost good faith. 2. Non-disclosure. If the insured fails to disclose all relevant information about the risk being insured, such as a previous loss or a known hazard, this may also be considered a breach of the principle of utmost good faith. 3. Misrepresentation during the claims process. If the insured provides false or misleading information during the claims process, such as concealing a prior loss or providing incorrect information about the circumstances of the loss, this may also be considered a breach of the principle of utmost good faith. 4. Failure to cooperate. If the insured fails to cooperate with the insurer during the claims process, such as failing to provide requested documentation or failing to attend a scheduled examination under oath, this may also be considered a breach of the principle of utmost good faith. 5. Policy abuse. If the insured engages in behavior that is designed to defraud the insurer, such as staging a loss or making false claims, this may be considered a breach of the principle of utmost good faith. These are just some examples of how the principle of utmost good faith may be breached in an insurance context. A breach of the principle of utmost good faith can have serious consequences, such as the denial of a claim or the cancellation of an insurance policy. It is important for both the insurer and the insured to act in good faith and to disclose all relevant information in order to ensure that the insurance contract is properly understood and fairly administered. In conclusion, the principle of utmost good faith is an important principle in insurance law that requires all parties involved in an insurance contract to act honestly and in good faith. This helps to ensure that insurance policies are properly assessed and that claims are handled fairly and efficiently. The end. Let us meet again shortly to continue with the class. Meanwhile, don't leave without subscribing, liking, and commenting. Good morning or good day to you, my friends. We are glad you are here. You are well, right? It is important to us that you are okay. Give us a comment to let us know the value the other videos have provided to you. This is our last video on the principles of insurance. The last, but not the least of these principles, is the principle of contribution. How is the principle of contribution defined? The principle of contribution is a concept commonly used in insurance and refers to the idea that multiple insurance policies covering the same loss or damage should each pay a proportionate amount towards the claim. Under this principle, if multiple insurance policies cover the same loss, each policy should pay only their proportionate share of the loss. The total amount paid out to the insured should not exceed the amount of the loss. This ensures that the insured is not overcompensated for their loss and that each insurer bears a fair share of the liability. For example, if a car is damaged in an accident and the owner has two insurance policies, one with coverage of $10,000 and another with coverage of $5,000, the principle of contribution would require that each policy pay a proportionate amount towards the total claim. Assuming the total cost of repairs is $12,000, the first policy would pay 5/8 or $7,500. And the second policy would pay 3/8 or $4,500. This ensures that the total payout does not exceed the actual cost of repairs and that each policy pays only their proportionate share. To determine the share of each insurer, The total amount of the loss will be calculated and then divided between the two policies based on the proportion of the total coverage provided by each policy. The policy with a higher coverage limit will be responsible for a larger share of the loss, while the policy with a lower coverage limit will contribute a smaller share. The application of the principle of contribution ensures that the insured party does not receive more compensation than the actual loss incurred, as the total payout from both policies cannot exceed the total amount of the loss. It also prevents the insured party from benefiting from multiple insurance policies covering the same risk. How contribution is applied in insurance. The principle of contribution is applied in insurance when an insured party has more than one insurance policy covering the same risk or loss. Contribution requires that each insurer pays their proportionate share of the loss or damage. The application of the principle of contribution involves the following steps. Identify the existence of multiple insurance policies covering the same risk or loss. Determine the extent of coverage under each policy. Calculate the total amount of loss or damage. Divide the total amount of loss or damage between the insurers based on who pays their proportionate share of the loss or damage up to the limit of their policy coverage. The application of the principle of contribution ensures that each insurer shares the loss or damage proportionately, and the insured party is not overcompensated for the loss or damage. It also helps prevent fraud and misrepresentation, as an insured party cannot benefit from multiple policies covering the same risk. Importance of contribution principle in insurance. The principle of contribution is essential in insurance because it ensures that each insurer contributes their fair share towards a claim when multiple insurance policies cover the same risk or loss. The importance of the principle of contribution in insurance includes: 1. Avoiding overcompensation. The principle of contribution prevents an insured party from receiving more compensation than the actual loss or damage incurred. Each insurer pays their proportionate share of the loss or damage, which ensures that the insured party is not overcompensated. 2. Preventing fraud. The principle of contribution helps prevent fraud and misrepresentation because an insured party cannot benefit from multiple policies covering the same risk or loss. It encourages insured parties to provide accurate information to insurers about their coverage to avoid fraudulent claims. 3. Encouraging fair competition. The principle of contribution promotes fair competition among insurers because it prevents one insurer from covering the entire cost of a claim when multiple policies cover the same risk. Each insurer shares the cost of the claim proportionately, which promotes fair competition and prevents one insurer from gaining an unfair advantage. 4. Saving costs. The principle of contribution helps to save costs for both insurers and insured parties because each insurer only pays their proportionate share of the claim, reducing the total payout amount. 5. Reducing ambiguity. The principle of contribution helps to reduce ambiguity and conflicts between insurers and insured parties because it provides a clear and straightforward method for determining the contribution of each insurer towards a claim. In summary, the principle of contribution is important in insurance because it promotes fairness, prevents overcompensation and fraud, encourages fair competition, saves costs, and reduces ambiguity. Contribution application in underinsurance. Underinsurance occurs when an individual or organization has an insurance policy that does not provide sufficient coverage to adequately protect against potential losses. This can have serious consequences for those who are underinsured, as they may find themselves financially vulnerable in the event of a major loss. However, there are several ways in which contribution applications can be used to address underinsurance. Contribution applications allow multiple insurers to share the risk associated with a single policy. This means that rather than relying on a single insurance provider to bear the full cost of a potential loss, multiple providers share the risk and contribute to the cost of the claim. This can be particularly useful in the case of underinsurance, as it allows individuals or organizations to obtain coverage from multiple providers and effectively increase the total amount of coverage available. For example, if an individual or organization has a policy with a limit of $500,000 but requires coverage of $1 million, they could potentially use a contribution application to obtain additional coverage from multiple insurers. In this scenario, Two insurers could each provide $250,000 in coverage, effectively doubling the total amount of coverage available. In addition to increasing the total amount of coverage available, contribution applications can also help to reduce premiums and provide more favorable terms and conditions. This is because the risk associated with a single policy is spread among multiple insurers, which can lead to lower costs and more favorable terms. Overall, contribution applications can be an effective way to address insurance and provide individuals and organizations with the coverage they need to protect against potential losses. By allowing multiple insurers to share the risk associated with a single policy, contribution applications can help to increase the total amount of coverage available, reduce premiums, and provide more favorable terms and conditions. Factors hindering the application of the principle of contribution. While contribution can be an effective tool for mitigating the risk of underinsurance, there are several factors that can hinder its application. Here are some of the factors that may make it difficult to apply the principle of contribution. 1. Coordination challenges. Contribution requires coordination among multiple insurers, which can be challenging to achieve. Each insurer may have different terms and conditions and may be reluctant to participate in a contribution agreement due to concerns about liability, profitability, or reputational risk. 2. Regulatory issues. The contribution may be subject to regulatory constraints, which can vary depending on the jurisdiction. Some regulators may require insurers to follow specific rules when entering into contribution agreements, which can make the process more complicated and time-consuming. 3. Administrative complexity. The administrative requirements of implementing a contribution agreement can be complex and time-consuming. Insurers may need to agree on a common policy wording, decide on how to allocate premiums and claims, and determine how to communicate with policyholders. 4. Disputes among insurers. Disputes among insurers can arise regarding the allocation of premiums, claims, or losses. Disputes can also arise regarding the interpretation of policy wording, which can be difficult to resolve without the involvement of legal experts. 5. Limited availability. The contribution may not be available in all insurance markets or for all types of policies. Some insurers may be unwilling or unable to participate in a contribution agreement, particularly if they do not have the necessary expertise, financial resources, or risk appetite. Overall, while contribution can be a powerful tool for managing risk awareness, insurers can educate policyholders about the benefits of the contribution principle, including how it can help to reduce premiums, increase coverage, and provide more favorable terms and conditions. Policyholders can also educate themselves about the concept of contribution and how it can be applied to their specific insurance needs. 2. Clear communication. Insurers can communicate clearly with policyholders about the terms and conditions of their policies, including any contribution requirements. Policyholders can also communicate their needs and expectations to insurers and seek clarification if they have any questions or concerns. 3. Cooperation in claims handling. Insurers and policyholders can work together to handle claims in a timely and efficient manner, which can help to minimize losses and reduce costs. This may involve providing accurate information and documentation, cooperating with insurers' investigations, and resolving disputes in a constructive manner. 4. Collaboration in risk management. Insurers and policyholders can collaborate on risk management initiatives such as loss prevention, safety training, and risk assessments. This can help to reduce the likelihood of claims and improve the overall risk profile of policyholders. 5. Advocacy for contribution. Insurers and policyholders can advocate for the use of contribution in the insurance industry by promoting the benefits of this approach to other stakeholders, such as regulators and industry associations. This can help to increase awareness and understanding of the contribution and encourage more insurers to adopt this approach. Overall, insurers and policyholders can work together to promote the use of contribution in the insurance industry by educating themselves and each other, communicating clearly, cooperating in claims handling and risk management, and advocating for this approach. By working together, Insurers and policyholders can help to realize the benefits of the contribution principle and improve the overall resilience of the insurance industry. Other instances where the contribution principle is applied in insurance. The contribution principle, also known as the principle of indemnity, is a fundamental concept in insurance that governs how losses are shared among policyholders. In addition to its application in property and casualty insurance, the contribution principle is also used in various other types of insurance, including 1. Health insurance. Health insurance policies typically require policyholders to pay a portion of their medical expenses out of pocket, which is known as the deductible. Once the deductible is met, the insurance company begins to pay a portion of the remaining medical expenses. The contribution principle is applied in health insurance when policyholders pay their premiums, which are used to cover the cost of medical care for all insured individuals. 2. Life insurance. In life insurance, the contribution principle is applied by pooling the premiums of all policyholders to create a fund that can be used to pay death benefits to the beneficiaries of policyholders who die during the policy term. 3. Unemployment insurance. Unemployment insurance is a government-provided benefit that is designed to provide financial assistance to individuals who have lost their jobs. The contribution principle is applied in unemployment insurance by requiring employers to contribute a portion of their payroll taxes to a fund that is used to pay benefits to unemployed workers. 4. Social Security. Social Security is a government program that provides retirement, disability, and survivor benefits to eligible individuals. The contribution principle is applied in Social Security by requiring workers to pay Social Security taxes on their earnings, which are then used to fund the program. In all of these examples, the contribution principle is used to ensure that the costs of losses or benefits are shared among a group of individuals rather than being borne by any one individual alone. Some instances where the principle of contribution is mentioned in insurance. The contribution principle is a fundamental concept in insurance that refers to the sharing of losses among multiple policyholders. Here are some instances where the contribution principle is mentioned in insurance. 1. Property and casualty insurance. In property and casualty insurance, the contribution principle is used to ensure that each policyholder pays a fair share of the cost of property insurance policy that covers damage caused by a storm. The insurance company will use the contribution principle to determine how much each policyholder should pay towards the cost of repairs. 2. Reinsurance. Reinsurance is a form of insurance that is purchased by insurance companies to protect against large losses. The contribution principle is used in when losses exceed a certain threshold. 3. Contribution clause. A contribution clause is a provision in insurance policy that requires policyholder has multiple insurance policies that cover the same loss. The contribution clause will specify how much each insurer should pay towards the cost of the loss. 4. Pro rata contribution. Pro rata contribution is a method of sharing losses among multiple insurance policies that cover the same risk. Under this method, each insurer pays a proportionate share of the loss based on the amount of insurance that they have provided. For example, if two insurers have provided $50,000 and $100,000 of coverage, respectively, they will contribute to the loss in a 1-to-2 ratio. 5. Excess insurance. Excess insurance is a type of insurance that provides coverage for losses that exceed the amount of coverage provided by the primary insurance policy. The contribution principle is used in excess insurance to determine how much each insurer should pay towards the cost of the loss, based on the amount of coverage that they have provided. Lastly, let us talk about the coinsurance. Coinsurance is a concept used in insurance that refers to the sharing of risk between the insurer and the insured. It is commonly used in property and casualty insurance, where the policyholder shares the risk of a loss with the insurer by agreeing to maintain a certain level of insurance coverage on their property. Under coinsurance, the policyholder agrees to maintain a specified percentage of insurance coverage on their property, typically 80% or 90% of the property's actual cash value. If the policyholder fails to meet this requirement and experiences a loss, they will only be reimbursed for a proportionate amount of the loss based on the percentage of the property's value that was insured. For example, if a property is insured for only 50% of its actual cash value and experiences a loss of $100,000, the insurance company will only pay 50% of the loss, or $50,000, and the policyholder will be responsible for the remaining $50,000. Coinsurance is intended to encourage policyholders to insure their property at an adequate level and to share the risk of loss with the insurer. It can also help to keep insurance premiums more affordable by ensuring that policyholders maintain adequate coverage and do not underinsure their property. Coinsurance is typically found in property and casualty insurance policies, including homeowners insurance, commercial property insurance, and business interruption insurance. We are glad you have accompanied us through the 7 principles of insurance. Have you received any value from these and our other videos? Please let us know in the comments section below. Many people are watching our videos, which makes us very happy. As you watch, please take a sec and subscribe so that we become a family. Bye-bye for now. Let's meet in another video soon. Hello, my friends. It's been a minute. I hope you have been watching our and learning from them. I am back with another one of my good. Last week, my colleague talked about unit trust investments in this video, and I thought it wise to explain what unit trusts are. What are unit trusts? In simple terms, a unit trust is an investment vehicle which pools money from many investors and invests the money in different investment instruments in order to realize both short and long-term goals. Investing as an individual can be very hectic since there are many investment vehicles such as shares or stocks, bank fixed deposits, foreign exchange markets, and so on. Each of the above-mentioned investment vehicles has different investment requirements, risk levels, and income levels. If you, as an individual, was to invest in all of them, you would probably lose money or earn very little. To help investors maximize their income, the market came up with unit trusts, which will pool money from many investors enough to be invested in all of the above-mentioned instruments, thereby ensuring that even an investor with limited cash can still enjoy income from across the financial sector without having to stretch too thin trying to meet the requirements of each investment vehicle. Unit trusts have a financial war chest to diversify into many markets, thereby ensuring that the net effect of financial market performance is always a positive return in terms of interest. That is why there is almost a guarantee of steady return month on month, even if one of the investment instruments, say stocks or Forex, is performing badly. In summary, unit trust sets up a fund which pools money from many investors and then spreads the pooled cash across many investment opportunities so as to realize a guaranteed return on investment while protecting the invested principal amount. We are working on a video to explain the different types of unit trusts and how they work. Subscribe, like, click on the notification to get a notification when we upload it, and many more. Hello there, my good friends. Friends help each other out, and I am here today to call you out on one and job. I want to create a problem for you, then show you how to solve it later. If you were born between 1971 and 1989, this is for you. Other viewers, stay tuned and learn. It has something to do with retirement. If you were born in 1971, your retirement year is 2049, with the others in between those years of birth set to retire between 2032 to 2048. The retirement age here is 60 years as set by the government and most pension schemes. Now, here's the problem. How adequate is your current savings towards your retirement? Hypothetically, let's assume that throughout your employment, you are earning around 100,000 shillings, which makes your presumed net earnings around 70,000 shillings. Of the net, the amount you will need to meet your daily needs in retirement, assuming there are no fees, rent, or major health issues to take care of. According to inflation figures seen by this channel, the inflation rate for the last 10 years has been ranging from 5.5% to 10% annually. If we were to take a reasonable rate of 8.5% inflation rate annually for the next 9 years, the 50 you need to live comfortably in 2023 will most likely be 104,000 shillings in 2031. Yes, that is inflation for you. A single tomato you are buying at 10 shillings today will most likely be 25 shillings in 2031 and 50 shillings in 2049. The life you are living comfortably with monthly expenses of 50,000 shillings now will need 104,000 shillings per month in 2031 for you to maintain the same lifestyle, hypothetically. I do not know what the experts say about pension fund adequacy because the numbers are mind-boggling. For an average person, they are likely to discourage you. Personally, I had set a target that I would want to retire with at least 6 years of my basic expenses requirement calculated in the year of my retirement. An example is, if I live comfortably with 50,000 shillings per month now, in 2031, that would be 104,000 shillings per month, having taken into account the inflation element. 6 years because my mind tells me that I can liquidate what I will need for my first year of retirement from the pension fund savings for use. Then find me a good investment advisor to help me make good investments out of the remaining 5 years pension savings left. If it goes well, and I bet it would, this can buy me another 15 to 20 years worth of income. We need to talk about this and put these investment advisors to task. If you are like me, and you were born in 1971, meaning you are retiring in 2031, your total pension fund amount should be at least 7,488,000 shillings. That is 7,488,000 Kenya shillings. That is 104,000 multiplied by 72 months or 6 years. If you were born in 1989, meaning your retirement year is 2049, you will need between 15 million to 20 million for your basic life in retirement of up to 6 years without having to work again. That is 50,000 shillings. The effect of inflation in 27 years, monthly expenses of 212,000 shillings multiplied by 72 months as done above will give you about 14.4 million shillings. Look at your year of birth, your expected retirement age, and your current pension fund balance. Where are you on this journey? Can we save it? Remember, these are hypotheticals. You could need less or more, but it forms a basis for a good place for you to look into the future and come up with your retirement plan. Disclaimer: we will talk about the best investment opportunities in retirement to guarantee you liquidity, but as a forewarning, it is not advisable to use your retirement money to build a house or rentals. This is a sure way of making sure you deplete your entire life savings in 4 months and live a miserable life for the next 5 years and probably die sooner. The figures given here are just for basic living in retirement. Build your house before you retire. If this caught your attention, subscribe. We would like you to ask yourself the following. 1. Are you saving for your retirement? 2. How are you saving for your retirement? Here are other questions to compound your problems. 1. Are you planning to retire and take a well-deserved rest, or will retire from one job and move to another to sustain your daily life? 2. Or will you depend on your children for daily sustenance? 3. How will you take care of your medical bills? 4. How is your social life? Do you have friends outside your work environment? Ponder these questions. I will be back with answers in the next video. Shortly, of course. As usual, hit that like button for other people to know we are doing a public good.
Hello there, my friends. We are glad you are here. Let's change the tune a little bit and talk about the retirement benefits schemes. We have a 4-part series for you that will cover the following. Part 1. Historical development and importance of retirement benefit schemes. Part 2. How to set up and maximize savings on your retirement schemes. Part 3. Challenges facing retirement benefit schemes. Part 4. Retirement benefit schemes, law and taxation. Let's start with Part 1. Historical development of retirement benefit schemes. Retirement benefit schemes are programs that are designed to provide financial support to individuals when they are no longer able to work to earn a living, also known as retirement years. The history of retirement benefit schemes dates back to 1800s when many countries were setting up a fund to provide income or financial support for the elderly who were not able to continue working. As times moved on, the retirement benefits sector became an industry on its own for employers' budget, making them unable to meet their budget benefits schemes to their employees. This gave rise to a method where employees were made to contribute a part of their salaries towards their retirement. Employers would match each of the employees' contributions. This was the beginning of a type of retirement benefit plan known as defined contribution plans. In a defined contribution plan, the employee and/or employer make contributions to a retirement account, which is invested to generate returns. The returns earned. Importance of retirement benefits plans. Retirement benefit plans are critical, very critical. Here are some reasons why. 1. Financial security in retirement. Retirement benefit plans provide financial security in retirement by ensuring that retirees have a steady source of income to support their living expenses. This is particularly important where the cost of living is high and many people may not have other sources of income in retirement. 2. Employer benefits. Many employers offer retirement benefit plans as part of their overall benefits package. This is an important way for employers to attract and retain employees, and it can help employees feel more secure in their jobs and in their financial futures. 3. Tax benefits. Retirement benefit plans often offer tax benefits, such as tax-deductible contributions or tax-free withdrawals in retirement. These tax benefits can help individuals maximize their retirement savings and reduce their tax burden. 4. Inflation protection. Many retirement benefit plans inflation by adjusting benefits for increases in the cost of living. This is particularly important because the rates of inflation globally are very high. 5. Social safety net. Retirement benefit plans can also provide a social safety net for retirees who may not have other sources of income or financial support. This can help reduce poverty and improve the overall well-being of retirees. In conclusion, retirement benefit schemes are important because they help individuals save for retirement, which is a goal to achieve on one's own. Having a structured retirement savings plan, these schemes can help individuals ensure that they have a steady source of income in retirement, which can help them maintain their standard of living and avoid financial hardship. We have come to the end of Part 1, which set up the tempo. Look out for Part 2 tomorrow. Meanwhile, hit that subscribe and like button. Hello and good day to you, our loyal viewers. We are growing in leaps and bounds, thanks to each and every one of you. We are passionate about insurance and investments, and that is why we have taken a step to educate you, our viewer, on these two topics. We are building a community of insurance and investment woke netizens and want to invite you to join us by subscribing to our channel and activating the notification bell so that you get notified every time we upload something. In the meantime, make a point of watching the already uploaded videos. There is much in there that we can learn together. Thank you so much. We look forward to seeing you in our next video.
To be having another day with you. To our friends who are new here, we always look at some Bible teachings on finance and insurance every weekend. Please subscribe and join us. The Son of God himself came and gave us many teachings which form part of our beliefs. We investigate whether there are some of these teachings and deeds that we can relate to insurance in our modern times. There are several deeds in Jesus' life that contain valuable teachings on investment, finance, and insurance. Here are a few examples. Example number 1. The parable of the talents as recorded in Matthew chapter 25, from verse 14 to verse 30. In this parable, Jesus tells the story of a master who gives his servants talents, a unit of money, to invest while he is away. 2 of the servants invest the talents and earn a profit, while one buries his talent in the ground. The master praises the 2 servants who invested wisely and rebukes the one who did not. This parable teaches the importance of investing wisely and not being afraid to take risks. It tells the story of a master who goes on a journey and entrusts his property to his servants. To one servant, he gives 5 talents of money, to another 2 talents, and to a third, 1 talent. When the master returns, he asks the servants what they did with the talents. The first 2 servants invested and doubled their talents, while the third servant buried his talent in the ground. The master was pleased with the first 2 servants, but angry with the third, who did nothing with what was given to him. How the parable of the talents, Matthew 25 verses 14 to 30, applies in finance and insurance teachings today. This parable has several applications in finance and insurance teachings today. Here are a few. Wise investing. The first 2 servants in the parable invested their talents and doubled them. This teaches us the importance of wise investing. In finance and insurance, it is important to research and understand the risks associated with any investment, and to diversify our portfolios to minimize those risks. This principle applies not just to financial investments, but also to insurance products like life insurance or disability insurance, ourselves for the unexpected and protecting ourselves and our loved ones from financial hardship. Taking calculated risks. This might mean investing in stocks or mutual funds, or taking out a policy with a higher deductible to lower monthly premiums. Stewardship. The parable teaches that we are stewards of the resources that we have been given, and that we have a responsibility to use them wisely. In finance and investments, and not take on too much debt or risk. We should also be good stewards of our insurance policies, making sure that we have the coverage we need and that we are not paying for coverage we don't need. Accountability. The parable also teaches that we will be held accountable for how we use the resources we've been given. In finance and insurance, this means that we should keep track of our investments and policies, and make sure that we are using them in a way that is consistent with our goals and values. Example number 2. The parable of the rich fool, recorded in the book of Luke chapter 12, from verse 13 to verse 21. In this parable, Jesus tells the story of a rich man who has a great harvest and decides to tear down his barns and build bigger ones to store his grain. He then tells himself, "Soul, you have ample goods laid up for many years. Relax, eat, drink, be merry." However, that very night, God takes his life, and he realizes that he cannot take his riches with him. This parable teaches the danger of greed and the importance of not putting all of our trust in material possessions. This parable has several applications in insurance today. Here are a few. Life insurance. The parable highlights the importance of life insurance. The rich man had plenty of grain stored up, but when he died, he left it all behind. Similarly, when we die, we leave behind our assets and our loved ones. Life insurance can provide a safety net for our loved ones and ensure that they are taken care of financially when we are gone. Estate planning. The rich man in the parable did not have an estate plan in place, and his wealth was left behind without any instructions for how it should be distributed. In insurance, estate planning is an important part of protecting our assets and making sure they are distributed according to our wishes. Disability insurance. The parable also highlights the importance of disability insurance. The rich man in the parable was not able to enjoy his wealth for very long because his life was demanded of him that very night. Similarly, an unexpected disability or illness can prevent us from enjoying our wealth and providing for our loved ones. Disability insurance can provide a safety net in case we are unable to work due to a disability or illness. Risk management. The rich man in the parable did not consider the risks associated with his wealth. He did not have a plan in place for how to manage his wealth in case of unforeseen events. In insurance, risk management is an important part of protecting our assets and ensuring that we are. The widow's mite, recorded in Mark chapter 12, from verse 41 to verse 44. In this story, Jesus observes a poor widow, while the wealthy people gave out of their very little to give. The parable of the widow's mite is a story in the Bible, found in Mark 12 verses 41 to 44, that teaches a valuable lesson about generosity and sacrifice. While the story itself may not directly apply to insurance, there are several lessons that we can draw from it that can be applied to insurance and personal finance. Here are 3 lessons from the widow's mite that can be applied to insurance today. Every penny counts. In the story, the widow gives 2 small coins, which were worth very little in terms of monetary value. However, Jesus praises her for her generosity, as she gave all she had. In the same way, when it comes to insurance, even small amounts of coverage can make a difference in protecting your finances and your loved ones. Assess your needs and budget to determine the appropriate amount of coverage, and not underestimate the value of even small insurance policies. Sacrifice for a greater good. The widow's sacrifice was an act of faith and love, as she gave all she had to God. In the same way, purchasing insurance is a sacrifice that can benefit you and your loved ones in the event of unforeseen circumstances. While insurance premiums may seem like a burden, they can provide a safety net and financial security in times of need. Giving from the heart. The widow's offering was not just about the monetary value, but the spirit in which it was given. She gave with a humble heart and a desire to help others. When it comes to insurance, it's important to choose a policy that aligns with your values and priorities. You should also consider working with an agent who understands your unique needs and can help you find the right coverage for your situation. In summary, the lessons from the widow's mite that apply to insurance today are: every penny counts, sacrifice for a greater good, and giving from the heart. By keeping these principles in mind, you can make informed decisions about insurance and financial planning that align with your values and priorities. Example number 4. The parable of the Good Samaritan, in Luke chapter 10, verses 25 to 37. In this parable, Jesus tells the story for dead on the side of the road. 2 religious leaders passed by without helping him, but a Samaritan, who was despised by the Jews, stops to help and pays for his care. This story teaches the importance of being prepared for unexpected expenses, such as medical emergencies, and the value told by Jesus in the Gospel of Luke that teaches valuable lessons about kindness, compassion, and caring for others. While the parable does not explicitly mention insurance, there are several principles that can be applied to the insurance industry and the way people approach the protection of themselves and others. Here are some insurance lessons from the parable of the Good Samaritan. Be prepared for the unexpected. The victim in the parable was attacked unexpectedly and left wounded on the road. Prepared for them. This is why having insurance coverage can be crucial to protecting yourself, your family, and your assets in the event of an unforeseen event. Care for others. The Good Samaritan stopped to help the victim even though he did not know him and was from a different social group. In the same way, insurance can be a way to show care and concern for others by protecting them from financial loss in the event of an accident, illness, or other unexpected event. Be willing to pay the cost. The Good Samaritan paid the cost of the victim's care without expecting anything in return. Similarly, insurance policies require payment of premiums, and it is important to be willing to pay the cost to ensure that you and your loved ones are adequately protected. Choose a reliable provider. The Good Samaritan took the victim to an inn where he knew he would receive proper care. When selecting an insurance provider, it is important to choose a company that is reliable and has a good reputation for providing quality coverage and customer service. Be proactive in protecting yourself and others. The victim in the parable was left vulnerable because he did not take precautions to protect himself. Similarly, it is important to be proactive in protecting yourself and others by taking steps such as purchasing insurance coverage, maintaining a healthy lifestyle, and practicing safe driving habits. Overall, Jesus' teachings emphasize the importance of wise investing, being wise with our finances, giving generously, helping those in need, not being greedy or materialistic, giving generously, and treating others with fairness and kindness. These 8 timeless principles that are still relevant and valuable in modern finance and insurance practices. That's all for today, folks. Let's meet again next weekend on this topic. Have a fantastic week ahead. Remember to like and share this video.
Good morning, or good day, my viewers. Boredom in retirement. Topic now in retirement. A well-grounded social life in retirement is one that provides retirees with a sense of purpose, belonging, and fulfillment through social interactions and activities. It involves building and maintaining relationships with a diverse group of people, including in a variety of social activities that align with one's interests and values. These are some of the activities that will keep you well-grounded in the community. 1. Improve your relationship with your family, including the extended family. This can be done by visiting them with a bond between yourself and your friends, also done through visits or hosting. 3. Improve your community profile by visiting them and participating in their activities such as weddings, funerals, barazas, harambes, or even agreeing to be part of a school board or PTA, etc. 4. Improve your profile at your local church by participating and volunteering at their events or even taking up leadership roles. 5. Introduce or reintroduce yourself to the local authorities like chiefs and their assistants. 6. Reconnect with old friends and offer them help whenever they need it. Some of the help here may be as simple as referring your children to a job. 7. If you were schooled in your locality, visit the school, offer mentorship, and talk to the students there. There are many ways of improving your social profile in the community. However, you make sure that whatever you do to the community is genuine and not done with ulterior motives. Working life can really consume your time and may keep you away from your old friends, your community, or your church, and this can be amended in your retirement. Overall, a well-grounded social life in retirement is one that supports and enhances one's physical, mental, and emotional well-being and contributes to a sense of overall happiness and fulfillment in life. Topic number 2. Killing boredom, things that can keep you busy in retirement. Retirement is a time for individuals to enjoy the fruits of their labor and explore new interests and hobbies. When you retire, most activity slows down. For those who are used to predictable life routines, you will feel like you have been thrown off a carousel, disoriented. You were used to waking up at 6 to go somewhere. Now the body still does that, but you have nowhere to go. It gets worse when your spouse and best friends are still working. You will be alone, bored, with nothing meaningful to do. If this is your cross, 1. Joining a community group or organization. There are many community groups and organizations that offer social and volunteer opportunities for retirees. Joining a group can provide hobbies and interests. Retirement is a great time to explore new hobbies or interests. Hobbies like gardening, painting, playing music, or taking up a sport. These hobbies can provide an opportunity to meet. Retirement provides an opportunity for retirees to explore new places and cultures. Traveling with family and friends or joining group travel tours can provide opportunities for socialization. Joining a travel group can be a great way to explore new destinations and meet other retirees who share similar interests. 4. Volunteering. Volunteering is a great way to give back to the community and meet new people. Retirees can give back to their community by volunteering their time and skills to organizations such as charities, joining a fitness group. Staying active is important during retirement, and joining a fitness group can provide opportunities for exercise and socialization. Way to stay active and meet new people. Participating in group fitness classes such as yoga, Pilates, or dance can help retirees stay active and healthy while also providing an opportunity to meet new people. 6. Book clubs. Joining a book club can provide retirees with the opportunity to read and discuss literature with like-minded individuals. 7. Music and art classes. Retirees can learn new skills and explore their creative side by taking music or art classes. 8. Outdoor activities. Engaging in outdoor activities such as hiking, bird watching, or gardening can provide retirees with a healthy and active life, while also enjoying the beauty of nature. 9. Game nights. Hosting or participating in game nights with friends and family can be a fun and social activity for retirees. 10. Social clubs. Joining social clubs such as a senior center or retirement community can provide retirees with opportunities to meet new people and participate in social events. 11. Cooking classes. Retirees can learn new cooking skills and enjoy meals with others by taking cooking classes or hosting dinner parties. 12. Educational classes. Retirees can expand their knowledge by taking classes at a local college or university, attending lectures or workshops, or participating in online learning platforms. 13. Social media. You can take this time to learn about social media such as Facebook, YouTube, Twitter, and others. Contrary to what you have been made to believe, social media can be useful if put to good use. Even traditional media have their social media sections doing even better. If it interests you, learn about it. That is if you stayed away from them during your working life. 14. Publish a book. Do you have at least 35 to 40 years of experience workplace? You are literally a walking library. Put some of those in a publisher to do the other bit. Book tours can also help shave a lot of your time and help you kill boredom. Overall, retirement can be a time to explore new interests and hobbies and engage in social activities that promote personal growth, physical activity, and socialization. It's important to find activities that you enjoy and that fit your individual interests and goals. You have dedicated most of your life to working and taking care of other people. This is the time for you to slow down, think about yourself, and do what interests you. There are many things you had wanted to do, but you were either limited by family responsibilities, time, or your work. This is the time to do them.
Hello viewers. Quick video. How often do you travel? Do you purchase travel insurance while traveling? Here is a brief explanation of what travel insurance is, what it covers, and why you need it every time you travel. Welcome to Insurance World. Travel insurance policies provide coverage for unexpected events that may occur while you are traveling. The coverage provided by a travel insurance policy can vary depending on the type of policy purchased and the insurance provider. It is a type of insurance that provides coverage for unexpected events that may occur while one are traveling and is designed to protect travelers against financial losses and other problems that may arise during their trip. Travel insurance typically covers a range of potential problems such as trip cancellation or interruption, medical expenses, baggage loss or delay, travel delays, and accidental death or dismemberment. Depending on the policy, it may also cover additional risks such as emergency medical evacuation, adventure sports, and rental car damage. Travel insurance can be purchased as a single trip policy or as an annual policy that covers multiple trips taken over a specific period of time. Policies can be customized based on the traveler's needs, destination, and type of trip. What is covered under travel insurance? Medical expenses. Coverage for medical expenses incurred due to illness or injury while traveling. This may include hospitalization, prescribed drugs, emergency medical evacuation or repatriation. Personal accident. Personal accident cover is an extension under the travel policy to take care of accidental death and permanent injuries. When you travel, the risk of getting injured accidentally or in an accident still exists, and this section will pay death benefits or permanent disability benefits. Trip cancellation or interruption. Coverage for reimbursement of prepaid, non-refundable expenses if you have baggage and personal belongings. Coverage for lost, stolen, damaged baggage or personal belongings during your trip. Travel delays. Coverage for expenses incurred due to travel delays such as accommodation, meals, and transportation. Some travel insurance policies also offer additional coverage options such as emergency medical evacuation. Coverage for emergency medical transportation to the nearest adequate medical facility. Adventure sports. Coverage for injuries or accidents that occur during adventure sports such as skiing, snowboarding, or scuba diving. Rental car damage. Coverage for damage to a rental car while traveling. Other covers may also provide repatriation of mortal coils when one dies while on travel. 2. Repatriation of the policy owner's a child or children when the policy owner dies abroad. 3. Repatriation of travel companion when the policyholder dies. 4. Burial or cremation expenses in the country of death, that is, if it is logistically challenging to repatriate the mortal remains. 5. Travel insurance can also pay for legal assistance when one gets in trouble abroad. 6. Travel insurance can also extend to cover public liability. When one travels abroad, duty of care still exists and third parties can still sue there if you injure them or damage their property. It's important to carefully review the coverage and policy terms and conditions before purchasing a travel insurance policy to ensure it meets engage in during your travels. Additionally, make sure to disclose any pre-existing medical conditions to the insurance provider as this may affect your coverage. Why you need travel insurance when traveling. There are several reasons why one may need travel insurance when traveling, including medical emergencies. Travel insurance can provide coverage for unexpected medical expenses that may arise while traveling. This is especially important if you are traveling to a foreign country where healthcare costs may be high, or your regular health insurance may not provide coverage. Trip cancellations or interruptions. Travel insurance can provide coverage for prepaid, non-refundable expenses if you need to cancel or interrupt your trip due to a covered reason such as illness, injury, or death. Lost or stolen baggage. Travel insurance can cover for lost or stolen baggage or personal belongings during your trip. This can help you avoid the financial loss and inconvenience of having to replace essential items. Travel delays. Travel insurance can provide coverage for expenses incurred due to travel delays such as accommodation, meals, and transportation. This can help you avoid the additional costs and stress of unexpected delays. Accidents and emergencies. Travel insurance can provide coverage for accidents and emergencies that may occur while traveling, including emergency medical evacuation or repatriation. Overall, travel insurance can provide peace of mind and financial protection for unexpected events that may occur while traveling. It's important to carefully review the coverage and policy terms and conditions before purchasing a travel insurance policy to ensure it meets your needs and provides adequate coverage for risks during your trip. Will you buy one next time you travel? Talk to us. We can hook you up with one. Rates are very pocket friendly. That's all for today, folks. Look out for our next video on policies tomorrow. Meanwhile, check out our channel for more videos, watch them, give us a like and subscribe. Boost your retirement benefits funds. 1. Make an additional voluntary contribution over and above what the employer can legally deduct from your salary. 2. Set up a separate individual pension plan and channel some money into that account. 3. Set us a money-generating activity as a side hustle before retirement. An activity such as baking can be done as a hobby, then build a list of loyal customers with time. 4. Invest in financial instruments like bonds, dividend-paying shares, and unit trusts. 5. Purchase land or properties in prime areas, then either put up rentals before retirement or plan to retire. Watch the full video of retirement planning on our channel. Hello viewers. There is an insurance policy whose popularity is on the rise in the recent past. That policy is Last Expense Cover, which is offered as a standalone benefit policy to take care of those who are not in organized groups like employment. Let's look at what this policy covers. Last expense insurance, also known as burial insurance or final expense insurance, is a type of life insurance policy that is designed to cover the costs associated with a person's funeral. The purpose of this type of insurance is to provide financial support for the deceased person's family and loved ones during a difficult time. Typically, last expense insurance policies are relatively small and provide coverage that can range from as little as 50,000 shillings all the way up to 500,000 shillings. The exact amount of coverage will depend on the policyholder's specific needs and budget. Unlike other types of life insurance policies, last expense insurance policies are typically easy to obtain and do not require a medical exam. However, they may come with higher premiums due to the increased risk associated with insuring older individuals or those with pre-existing medical conditions. Rising demand for last expense covers. The last few years have seen a rise in demand for more information on last expense insurance cover. This has driven industry players to design a standalone last expense insurance product, with their main target being organized groups. These are some of the factors contributing to the rise in demand for last expense insurance covers. 1. Rising funeral costs. Funeral costs have been on the rise in recent years, and this has made it difficult for many families to cover the costs of a loved one's funeral. Last expense covers can help to alleviate this financial burden and ensure that families can give their loved ones a dignified send-off. 2. Limited access to traditional funeral cover. Traditional funeral covers are often designed for groups, such as members of a particular church or community. This can make it difficult for individuals who are not part of these groups to access funeral cover. Last expense covers offer a more accessible, very convenient and affordable way to do so. It is common knowledge that the fundraising that people use to hold for funeral arrangements are slowly dying because of this awareness. 4. Changing attitudes towards life insurance. People recognizing the benefits of having insurance to protect. Last expense covers offer a simple and affordable way. In many funerals are an important event, and there are cultural expectations around how they should be conducted. This can include the need for elaborate ceremonies and the provision of food and refreshments for mourners, which can significantly increase the cost of the funeral. Urbanization. As the population continues to urbanize, the cost of living in urban areas has increased. This includes the cost of funerals, which can be significantly higher in urban areas than in rural areas. Inflation. Inflation has been a significant challenge in recent years, and this has impacted the cost of funerals. The cost of funeral-related expenses, such as coffins, transportation, and flowers, has increased as a result of inflation. Limited competition. The funeral industry is largely dominated by a few large companies, which can limit competition and drive up prices. This can make it difficult for families to find affordable funeral services. Lack of planning. Many families do not plan for funerals, which can make it difficult to manage the cost of the funeral when a loved one passes away. This can lead to families overspending or taking on debt to cover the cost of the funeral. Individual budgetary items that could make funeral arrangements costly. There are several items that can make funerals more expensive in Kenya, including 1. Medical bills. There are instances where someone dies in hospital after a long illness and the medical bills have not either been paid, or was partly paid. The hospitals do insist that these medical bills will have to be paid before they can release the body for burial. This can drive up the cost of funeral arrangements since the medical bills will have to be paid first. 2. Funeral homes or mortuary services. Funeral homes offer a range of services, including embalming, transportation, and preparation of the body. These services can significantly increase the cost of the funeral. 3. Coffins and caskets. Coffins and caskets can be one of the most significant expenses associated with funerals. Depending on the type of coffin or casket selected, the cost can range from several thousand to tens of thousands of Kenyan shillings. 4. Flowers and decorations. Flowers and decorations can add to the overall cost of the funeral. This includes arrangements, wreaths, and other decorations used to adorn the casket or the burial site. 5. Transportation. Transportation costs can be a significant expense associated with funerals. This includes the cost of transporting the body from the mortuary to the funeral home or place of worship and then to the burial site. 6. Catering. It is customary in many Kenyan cultures to provide food and refreshments for mourners during the funeral. Catering can add to the overall cost of the funeral. 7. Grave site preparation. The preparation of the burial site, including digging and filling the grave, can also add to the cost of the funeral. 8. Funeral programs and printing. Many can include photographs, poems, other information about the deceased. The cost of printing these programs can add to the overall cost of the funeral. Other items driving up the cost of funerals are tents and chairs, public address systems and security, among others. These items can make funerals more expensive, and families should carefully consider which services and products they need to ensure that the funeral is both affordable and dignified. Importance of having a last expense cover. Having a last expense cover can be important for several reasons. Expensive, and having a last expense cover can provide financial protection for your loved ones. It can help to alleviate the financial burden that your family may face during an already difficult time. 2. Peace of mind. Knowing that you have a last expense cover can provide peace of mind, both for you and your family. It ensures that your final expenses will be taken care of, without placing a financial burden on your loved ones. 3. No delays in funeral arrangements. Without a last expense cover, your family may have to wait for funds to be raised before they can pay for your funeral arrangements. This can cause unnecessary delays and additional stress during an already challenging time. Availability of cash eases planning and reduces the duration of the funeral. 4. No need to use savings or retirement funds. If you don't have a last expense cover, your family may have to dip into savings or retirement funds to cover your burial expenses. This can have long-term financial implications for your loved ones. The last expense protects family wealth from depletion during funeral arrangements. 5. Flexibility. Last expense covers are typically smaller policies, which means they can be more affordable than other types of life insurance policies. This makes them a flexible option that can be tailored to your specific needs and budget. 6. Provides you with relief from the burden of raising funds from friends and family members. Death can occur at any time. Without financial preparation, a family will obviously strain while raising funds to meet the burial expenses. This is even more real with the current inflation and recession being witnessed. The last expense payout will take care of these expenses, therefore, reducing the burden. 7. Helps you give your loved one a dignified clothes, lowering gear, etc. are deemed to be prestigious and can raise the profile of a funeral event. With the last expense payment, one is able to easily get these items and give their loved ones a dignified, especially when there are bills to be paid and some of the family members may feel that they are carrying a lot of burdens. This can lead to resentment towards perceived not to be pulling enough weight. Overall, having a last expense cover can provide important financial protection and peace of mind for you and your family during a difficult time. Now that we have seen the importance of last expense cover, let's see who can purchase it, who it covers, and how it works. Last expense cover is purchased by an individual alone or as part of a group to cover members of his or her family. The policy is designed to cover 1. The member who is the policy owner. 2. Spouse. 3. Children. 4. Parents, and 5. Parents-in-law. When one is desirous of purchasing this cover, they will be provided with various limits and applicable premiums for each limit. They will then choose a limit suitable for them, provide necessary documents as requested by the insuring company, and pay the premiums for the cover to bind. When the policy owner or any of the mentioned dependents passes on, the policy will pay the last expense benefit to assist the family with the funeral expenses of a departed family member. Claiming the benefits under this policy is simple. Report to the insurance company and provide the required claims documents for the insurance company to pay. What do you think about this policy? Do you want one? Visit your insurance provider or call us. We hope this has shed some light. Please support us by commenting and liking our videos. We will see you again soon.
Hello viewers. Welcome to yet another video. How are we doing on the other videos, by the way? Any comments? We would love to hear from you. This time, we take a look at what critical illness insurance policy is and how it can help you. This is the insurance world. Let's talk about some insurance. A critical illness insurance policy is a type of insurance policy that will pay a lump sum if the policyholder is diagnosed with a critical or serious illness or medical condition that is specified in the policy. When a policyholder goes to the hospital and is diagnosed with any of the critical illnesses, he or she can lodge a claim with their insurance company and provide relevant documents. Then they will be paid the lump sum as agreed in the policy they purchased. The purpose of critical illness insurance policy is to provide financial support to the policyholder and their family, medical bills, and other expenses related to the critical illness. The illnesses or medical conditions that are covered can vary depending on the policy, but typically include serious conditions such as cancer, heart attack, stroke, organ transplant, major surgery, multiple sclerosis, and blindness. It's important to note that critical illness insurance policy is not the same as life assurance policy. Life assurance policy provides a lump sum payment to the policyholder's beneficiaries upon the policyholder's death. Critical illness insurance policy pays a lump sum to the policyholder upon diagnosis of any critical illnesses while the policyholder is still alive. This policy is also different from a medical policy. Whereas medical policy will generally pay for the hospital treatment expenses, this policy will pay the policyholder, and it is up to the policyholder to decide whether to pay medical bills or do something else. Any critical illness insurance policy is designed to provide financial support while the policyholder is still alive, but unable to work due to their illness or condition. Why a critical illness insurance policy is important. Critical illness insurance policy is important because it provides financial protection and peace of mind in a difficult and potentially expensive time. Here are some reasons why it's important. Covers medical expenses. Upon diagnosis, managing critical illnesses can be very, very expensive. Expenses such as medical treatments, surgeries, hospital stays, or even overseas evacuations will generally require one to dig deeper into their pocket to finance. If you have a critical illness insurance policy, it will pay a lump sum that can help cover these costs and alleviate the financial burden on the policyholder and their family. Provides income replacement. As mentioned above, the critical illness insurance policy pays a lump sum to the policyholder upon being diagnosed with any of the covered critical illnesses. This means, therefore, that the policyholder can use the lump sum payment as income replacement. If a policyholder is unable to work due to a critical illness, the policy's lump sum payment can provide income replacement, allowing reduces stress. A serious or critical illness can be emotionally and financially stressful. Payment under this critical illness insurance policy can help reduce stress by providing financial support, so the focus can be on recovery. Offers flexibility. How to get a critical illness insurance policy. For those who are in employment and are fortunate enough to have a group like the death benefit or a standalone cover, which means that the payment under critical illness is confirmed if your group life policy has this extension. If it does, you are good to go. For those who are self-employed, there is standalone critical illness purchased on its own. Premium to be paid under this policy, in case one is buying as an individual, is very affordable. You will be surprised at how much it costs. Find out about the critical illness insurance policy from your insurance intermediary and purchase it to protect yourself and your loved ones. How to claim under the critical insurance policy. Claiming under this policy is very simple. Upon this, request your doctor to send the medical report to your insurance company. They will then provide you with a claim form which you will complete, attach any requested documents, and forward to your insurance for payment. The above process applies to all critical illness insurance policy claims, whether the policy was bought by the employer, corporate, or as an individual. Overall, a critical illness insurance policy is an important insurance policy to consider, as it can provide valuable financial protection and peace of mind during a difficult time. Our advice: consider purchasing this policy and you will have peace of mind if the critical illness does strike. Of course, we pray for your continued good health and good life. That right there is our checkered flag. We meet again tomorrow for more of these policies. Before we log out, 5 seconds for you to subscribe and like our video. Hello and welcome to our video lesson on crop insurance. In this lesson, we will explore the basics of crop insurance, including what it is, how it works, and the benefits it provides to farmers. Crop insurance is an important tool for managing risk and protecting against unexpected losses in the agricultural sector. As a commercial farmer, you face a variety of risks, from weather events to pests and disease, that can impact your crop yields and revenue. Crop insurance can help you manage these risks and ensure the continued viability of your business. In this video, we'll provide an overview of the different types of crop insurance policies, the underwriting requirements for coverage, and the claims process for receiving compensation for losses. Farming as a career means that your life depends on the safety and well-being of your livestock or crops. Commercial farming has been practiced by other continents for years, and it is now taking roots in commercial farming comes with many challenges and risks. It is these risks that insurance companies endeavor to alleviate from farmers. Whether you're a new or experienced commercial farmer, this video lesson will help you understand the basics of crop insurance and how it can benefit your operation. So, let's get started. What is crops insurance policy? Crop insurance is a type of insurance that provides financial compensation to farmers in the event of loss of the insured crops due to failure or damage caused by natural disasters such as hail, drought, and floods, pests, or other perils. Crops insurance can also be extended to cover commercial tree farms, fruit orchards, natural forests, and tree nurseries against the aforementioned perils. The specific coverage provided by crop insurance can vary depending on the policy and the insurer, but typically includes 1. Yield loss. This coverage compensates farmers due to a decrease in the quantity or quality of the crop caused by a covered peril, such as drought, excessive rain, frost, hail, or disease. 2. Price loss. This coverage provides protection against a decrease in crop prices, which can be caused by factors such as market fluctuations, oversupply, or 3. Revenue loss. This coverage combines yield and price loss coverage to protect against a decline in overall revenue due to a covered peril. 4. Prevented planting. This coverage compensates farmers for the costs of preparing land for planting when they are unable to plant due to a covered peril, such as excessive rain or flooding. Overall, crop insurance is designed to provide financial stability to farmers and ensure the continued production of food and other agricultural products, even in the face of unpredictable and uncontrollable risks. Different types of crop insurances are multi-peril crop insurance and peril crop insurance. 1. Multi-peril crop insurance, MPCI. Multi-peril crop insurance, MPCI, is a type of crop insurance policy that provides coverage for multiple perils or risks that can impact crop production. Assorted natural calamities such as drought, uncontrollable pests and diseases, hailstone damage, flooding, fire, lightning, earthquake, explosion, frost, and windstorm. MPCI policies are typically offered by private insurance companies. However, the government, through relevant ministry, can also design a compensation for the affected farmers in cases where there is a widespread loss due to an act of God, such as earthquakes, landslides, or even terrorism activities. MPCI policies provide protection for farmers by guaranteeing a minimum level of revenue or yield, depending on the policy. If a farmer experiences a loss due to a covered peril, the policy will provide compensation to help cover the cost of replanting, lost revenue, or other expenses. To qualify for MPCI coverage, farmers must typically meet certain eligibility requirements, such as planting within specified planting dates, using approved crop practices, and reporting accurate crop yields. Premiums for MPCI policies are based on the level of coverage selected by the farmer, as well as the type of crop, location, and other factors. Features. In this, we cover all sorts of crops in a single strand of large or small farms. The claim payable is determined by a qualified expert who inspects and scientifically quantifies the magnitude of the loss. Benefits. Cover for all kinds of crops, stability, improved financial management, and comfort in knowing there is a safety net for unexpected loss and associated costs. 2. Named Peril Crop Insurance, NPCI. Named Peril Crop Insurance, NPCI, is a type of crop insurance policy that provides coverage for specific perils or risks that can impact crop production, such as hail, drought, or excessive rain. Unlike multi-peril crop insurance, MPCI, which provides coverage for a wide range of perils, NPCI policies only provide coverage for the specific perils named in the policy. To qualify for NPCI coverage, farmers must typically meet certain eligibility requirements, such as planting within specified planting dates, using approved crop practices, and reporting accurate crop yields. Premiums for NPCI policies are based on the level of coverage selected by the farmer, as well as the type of crop, location, and other factors. Underwriting requirements for crop insurance. Underwriting requirements for crop insurance are the criteria that insurance companies use to determine if a farmer is eligible for coverage and to calculate the premiums for that coverage. These requirements can vary depending on the type of crop insurance policy and the insurer, but generally include the following. 1. Eligible crops. Only certain crops are eligible for crop insurance coverage, and these crops may vary depending on the geographic location and climate of the farm. 2. Planting dates. Farmers must plant their crops within a specified period to be eligible for coverage. 3. Approved practices. Farmers must use approved crop practices, such as using certified seeds or following specific planting and harvesting procedures, to be eligible for coverage. 4. Accurate reporting. Farmers must report accurate premiums. Farmers must pay premiums for their coverage, which are calculated based on the level of coverage selected, the value of the crop, and other factors. 6. Compliance with government regulations. Crop insurance policies are often subsidized by the government, and farmers must comply with government regulations related to the program, such as conservation practices or restrictions on certain crops. Overall, underwriting requirements for crop insurance are designed to ensure that farmers are using best practices to maximize crop yields and minimize risk. By meeting these requirements, farmers can protect themselves against unexpected losses due to weather, pests, or other perils that could impact their crops. Claim procedures under crop insurance. The claims process for crop insurance is designed to provide compensation to farmers who have experienced crop losses due to covered perils or risks. The specific claims procedures can vary depending on the type of crop insurance policy and the insurer, but generally follow these steps. 1. Notify the insurer. Farmers must notify their crop insurance company as soon as possible after experiencing a loss or damage to their crops. This notification may need to be made within a specific period to be eligible for coverage. 2. File a claim. Farmers must file a formal claim with their insurer, providing documentation of the crop damage or loss, as well as any other required information such as acreage and crop yields. 3. Inspection. The insurance company will send an adjuster to inspect the damaged crops and verify the extent of the loss. The adjuster may also take photographs, review records, and interview the farmer to gather additional information. 4. Payment. If the loss is covered by the policy, the insurer will issue a payment to the farmer based on the level of coverage and the extent of the loss. 5. Dispute resolution. If the farmer disagrees with the adjuster's assessment of the loss, there may be a process for dispute resolution or appeal. It's important for farmers to understand the specific claims procedures and requirements for their crop insurance policy, as well as to keep accurate records of their crop yields and losses. By following the claims process and meeting all the requirements, farmers can ensure that they receive the maximum compensation possible for their losses. Benefits of crop insurance to farmers. Crop insurance provides a number of benefits to farmers, including 1. Protection against unexpected losses. Crop insurance protects farmers against unexpected losses due to weather, pests, and other perils that can impact crop yields and revenue. By providing a safety net for these losses, crop insurance can help farmers manage risk and ensure the continued production of crops. 2. Access to credit. Many lenders require farmers to have crop insurance before they can qualify for loans or other forms of credit. By providing assurance to lenders that they will be able to repay their loans even in the event of a crop loss, crop insurance can help farmers access the financing they need to grow their businesses. 3. Increased profitability. Crop insurance can help farmers maintain profitability even in the face of unexpected losses. By providing compensation for losses, crop insurance can help farmers cover the cost of replanting, lost revenue, or other expenses, allowing them to continue operating their businesses and maintaining their livelihoods. 4. Flexibility and customization. Crop insurance policies can be tailored to meet the specific needs and risks of individual farmers, allowing them to choose the level of coverage and types of perils that are most relevant to their operations. 5. Government subsidies. Many crop insurance policies are subsidized by the government, which can help make them more affordable for farmers. These subsidies can help reduce the cost of premiums and make crop insurance more accessible to smaller or less established farmers. Risk to grow their businesses. By protecting against unexpected losses and providing a safety net for crop production, crop insurance is an important tool for ensuring the continued production of crops and the viability of the agricultural sector. We have come to the end of this lesson. Please let us have your comments in the comments section. We will be back with another lesson shortly. Welcome to Lesson 2 on the role of business development and marketing in the insurance industry. In this video, we will look at the role of business development as a function in the insurance industry and discuss the following subtopics. Subtopic A, importance of business development. Subtopic B, developing strategic partnerships. Subtopic C, identifying new business opportunities. Subtopic D, expanding customer base. Subtopic E, enhancing product portfolio. Subtopic F, driving revenue growth. Subtopic G, role of innovation in the insurance industry. Subtopic H, insurance distribution channels. Subtopic I, role of insurance brokers and agents in business development. Whether you're a seasoned professional or just starting out in the insurance industry, this video will provide valuable insights and practical tips for driving business growth and success. So, let's dive in. Subtopic A, importance of business development in the insurance industry. Business development is critical in the insurance industry as it helps insurance companies grow and expand their customer base, improve their profitability, and stay competitive in the market. Here are some of the key reasons why business development is essential in the insurance industry. 1. Attracting new customers. In today's competitive market, insurance companies need to develop innovative products and services that meet the changing needs of their customers. Business development helps insurance companies identify and reach out to new customer segments, expanding their customer base and increasing revenue. 2. Retaining existing customers. Business development also helps insurance companies retain their existing customers by providing them with better products, services, and customer experiences. By building strong relationships with customers and anticipating their needs, insurance companies can improve customer loyalty and reduce churn. 3. Developing new products and services. Business development enables insurance companies to stay ahead of the curve by developing new products and services that meet the changing needs of the market. This helps insurance companies differentiate themselves from their competitors and build a reputation as innovative and forward-thinking companies. 4. Expanding into new markets. Business development also helps insurance companies expand into new markets, both geographically and in terms of new product lines. By identifying new opportunities and developing the right strategies to enter these markets, insurance companies can grow their business and increase their market share. Overall, business development is critical to the success of insurance companies. It helps them stay competitive, grow their customer base, and improve their profitability by developing new products, expanding into new markets, and providing better customer experiences. Subtopic B. Developing strategic partnerships for the insurance sector. Developing strategic partnerships in the insurance sector can help companies expand their market reach, increase revenue, reduce costs, and enhance customer experience. Here are some steps to consider when developing strategic partnerships in the insurance sector. 1. Identify potential partners. Identify potential partners who can bring complementary products, services, or expertise that can add value to your company's offerings. These partners could be other insurance companies, technology providers, healthcare providers, or financial institutions. 2. Assess the fit. Once you've identified potential partners, assess their compatibility with your company's goals and culture. Evaluate their reputation, financial stability, and the potential impact of the partnership on your company's brand. 3. Define the objectives. Define the objectives of the partnership, including the target market, the scope of the partnership, and the expected outcomes. Ensure that the objectives are aligned with your company's strategic goals. 4. Create a value revenue growth or customer satisfaction and articulate how the partnership can achieve outcomes. 5. Negotiate the terms. Negotiate the terms of the partnership, including the roles and responsibilities of each party, the resources required, the timeline, and the metrics for measuring legally binding. 6. Implement the partnership. Once the agreement is finalized, implement the partnership by integrating about the partnership and its benefits. 7. Monitor and evaluate. Monitor and evaluate the partnership regularly to ensure that it is achieving the desired outcomes. Make adjustments as necessary to optimize the partnership's performance. Overall, developing strategic partnerships in the insurance sector can be a powerful way to drive growth and create value for your company and your customers. By following these steps, you can increase your chances of success and build long-lasting relationships with your partners. Examples of partnerships in the insurance industry. There are many examples of partnerships in the insurance industry, including 1. Insurtech companies partnerships. Many insurers are partnering with tech and online malls to enhance their digital capabilities and improve the customer experience. For example, an insurance company may consider partnering with online malls for distribution and sales to ensure that one can buy insurance products online, just like they do other items such as electronics or apparel. 2. Insurer-bank partnerships. Insurers are partnering with banks to offer insurance products to bank customers. Banks have a wide customer base and huge reach through their branch networks. The insurance sector can use these two to optimize reach and product penetration. Bank assurance is a good example. 3. Insure healthcare provider partnerships. Insurers are partnering with healthcare providers to offer health insurance products and services. For example, local hospitals can provide spaces for health insurance companies to either pitch tents for direct sales or provide a platform for relaying information about medical insurance products. 4. Insure automaker partnerships. Insurers are partnering with automakers to offer telematics-based insurance products. For example, car dealers partner with various insurance companies to enable car dealers to embed insurance costs into the vehicle prices, thereby increasing market reach while ensuring efficiency by providing a car buyer with a total solution, i.e. car sale and insurance at one stop. This is also known as cross-selling. 5. Insure nonprofit partnerships. Insurers are partnering with nonprofit organizations to provide insurance products and services to underserved communities. For example, an insurance company can partner with an NGO to offer microinsurance products to low-income individuals in emerging markets. 6. Affinity group partnerships. Insurance companies can partner with affinity groups, such as professional associations or alumni networks, to offer discounted insurance products to members. For example, an insurance company could partner with a medical association to offer medical broker partnerships. Insurance companies can partner with brokers to expand their distribution network and increase sales. For example, buying resources and a strategic alliance to jointly offer a new product that leverages the strengths of both companies. Overall, partnerships in the insurance industry are becoming increasingly common as companies look for ways to expand their reach, improve their offerings, and create more value for their customers. Subtopic C. Identifying new business opportunities. Identifying new business opportunities in the insurance sector can be challenging, but there are several approaches you can take to uncover potential areas of growth and innovation. Here are some steps you can take. 1. Keep up to date with industry trends. Stay informed about emerging trends in the industry by attending conferences, reading industry publications, and monitoring the news. This can help you identify new opportunities that align with market demand. 2. Analyze customer needs. Conduct market research to understand the needs and preferences of your target customers. Consider surveying existing policyholders, interviewing potential customers, and analyzing customer feedback to identify areas where insurance products and services can be improved or expanded. 3. Study your competition. Research your competitors to identify areas where you can differentiate your products or services. Look for gaps in the market where your competitors are not meeting the needs of customers or where you can offer a unique value proposition. 4. Identify emerging technologies. Keep an eye on emerging technologies and how they can be applied to the insurance industry. For example, blockchain technology can be used to improve transparency and efficiency in claims processing, while artificial intelligence can be used to automate underwriting and improve risk assessment. 5. Consider partnerships. Explore partnerships with other companies in the insurance industry or related fields to expand your offerings and access new markets. For example, partnering with a health and wellness company could enable you to offer insurance policies that cover alternative therapies or fitness programs. By following these steps, you can identify new business opportunities in the insurance sector that align with customer needs, market trends, and emerging technologies. Examples of emerging trends that may require new or redesigned insurance policies. 1. Cybersecurity insurance. With the increasing frequency of cyber attacks, there is a growing need for cybersecurity insurance. Insurance companies can offer policies that cover losses resulting from cyber attacks, such as data breaches and business interruptions. 2. Usage-based insurance. Another emerging trend is usage-based insurance, which uses telematics data to offer personalized insurance rates based on individual driving habits. This approach is particularly appealing to younger drivers who want to pay for insurance based on their actual usage rather than a flat rate. 3. Health and wellness insurance. With the rising cost of healthcare, there is an opportunity to offer insurance policies that focus on health and wellness. These policies could include coverage for alternative therapies, preventative care, and fitness programs. Insurers can also offer a well-rated medical insurance product to offer full coverage of pre-existing and chronic conditions instead of shying away from these chronic illnesses. 4. Environmental insurance. As businesses become more aware of their impact on the environment, there is an opportunity to offer insurance policies that cover losses resulting from environmental damage or pollution. 5. Peer-to-peer insurance. Peer-to-peer insurance allows individuals to pool their resources to insure against a specific risk. This model is similar to crowdfunding and has the potential to disrupt the traditional insurance market. 6. Insurance for the sharing economy. As the sharing economy continues to grow, such as Airbnb hosts and Uber drivers. 7. Insurance for autonomous vehicles. With the rise of autonomous vehicles, there is a growing need for insurance policies that cover the unique risks associated with this technology, such as accidents caused by software errors or cyber attacks. These are just a few potential business opportunities in the insurance sector. As with any business venture, it's important to conduct thorough market research and analysis before investing resources into a new business idea. Subtopic D. Expanding customer base. Expanding your customer base in the insurance industry is crucial for long-term growth and success. Here are some strategies you can use to attract new customers and retain existing ones. 1. Leverage digital marketing. In today's digital age, use social media and search engine optimization, SEO, to reach potential customers and build brand awareness. 2. Offer personalized policies. Customers are looking for insurance policies that meet their specific needs. Consider offering personalized policies that cater to the unique needs of your customers, such as usage-based insurance or health and wellness policies. 3. Provide excellent customer service. Excellent customer service is essential for retaining customers and building a positive reputation. Make sure your customer service team is responsive, knowledgeable, and empathetic. 4. Develop relationships with intermediaries. Work with intermediaries such as brokers and agents to reach new customers and build relationships with existing ones. Provide them with the tools and resources they need to sell your policies effectively. 5. Offer incentives. Offer incentives such as discounts, cashback, or other rewards to encourage customers to sign up for policies or renew their existing ones. 6. Emphasize financial stability and reliability. Customers want to know that their insurance provider is financially stable and reliable. Make sure you have a strong financial rating and emphasize your commitment to transparency and ethical business practices. 7. Invest in customer education. Many customers are unsure about the complexities of insurance policies and may not fully understand what they are buying. Offer educational resources such as webinars, blogs, and workshops to help customers make informed decisions. By leveraging these strategies, you can expand your customer base in the insurance industry and build a strong, sustainable business. Subtopic E. Enhancing product portfolio. Enhancing your insurance product portfolio can help you better meet the evolving needs of your customers, differentiate yourself from competitors, and grow your business. Here are some strategies you can use to enhance your insurance products portfolio. 1. Conduct market research. Conduct market research to understand the needs and preferences of your target customers. Look for gaps in the market where your competitors are not meeting the needs of customers or where you can offer a unique value proposition. 2. Identify new product opportunities. Identify new product opportunities by considering emerging trends, customer feedback, and the changing regulatory landscape. For example, you could explore offering cyber insurance or policies for the sharing economy. 3. Offer customized products. Consider offering customized products that cater to the unique needs of your customers. For example, you could offer usage-based insurance that allows customers to pay for coverage based on their actual usage. 4. Bundle products. Bundle multiple products together to offer a comprehensive package of insurance coverage. This can make it easier for customers to purchase the coverage they need and can also increase your revenue. 5. Emphasize digital capabilities. Invest in digital capabilities to enhance the customer experience and make it easier for customers to purchase and manage their policies online. For example, you could offer an online portal where customers can access their policy information and make changes as needed. 6. Explore partnerships. Consider partnering with other companies in the insurance industry or related fields to expand your product portfolio and reach new markets. For example, you could partner with a health and wellness company to offer policies that cover alternative therapies or fitness programs. By leveraging these strategies, you can enhance your insurance product portfolio and better meet the needs of your customers. It's important to regularly review and update your product offerings to ensure they remain relevant and competitive in the marketplace. Subtopic F. Driving revenue growth. Driving revenue growth in the insurance sector requires a strategic approach that focuses on increasing sales and reducing costs. Here are some strategies you can use to drive revenue growth. 1. Expand your product portfolio. Expanding your product portfolio can help you attract new customers and generate additional revenue streams. Consider offering new types of insurance policies or expanding into related fields such as financial planning or risk management. 2. Focus on customer retention. Retaining existing customers is often more cost-effective than acquiring new ones. Invest in customer service, personalized policies, and loyalty programs to keep your customers satisfied and loyal to your brand. 3. And insights that can be used to improve your sales and marketing efforts. Use data to segment your customer base, identify areas for cross-selling and upselling, and refine your pricing strategies. 4. Emphasize digital capabilities. In today's digital age, it's important to have a strong online presence. Invest in digital capabilities such as mobile apps, online portals, and chatbots to improve the customer experience and streamline your operations. Make it more efficient team or partnering with intermediaries such as brokers and agents. Efficiency can help you increase your profitability. Look for opportunities to automate processes, reduce waste, and streamline your operations. 7. Embrace innovation. Embracing innovation can help you stay ahead of the competition and have revenue growth. Consider investing in emerging technologies such as blockchain, artificial intelligence, or the Internet of Things to improve your products and services. By using these strategies, you can drive revenue growth for your insurance business while also improving the customer experience and enhancing your competitive position in the market. Subtopic G. Role of innovation in the insurance industry. Innovation plays a crucial role in the insurance industry by helping companies stay competitive, improve customer experience, and drive growth. Here are some key ways that innovation is transforming the insurance industry. 1. Product development. Innovation is enabling insurers to develop new and innovative products that better meet the evolving needs of their customers. For example, usage-based insurance, pay-as-you-go insurance, and on-demand policies are just a few of the innovative products that have emerged in recent years. 2. Customer experience. Innovation is also helping insurers improve the customer experience by making it easier for customers to purchase and manage their policies. For example, Digital capabilities such as mobile apps, online portals, and chatbots are enabling customers to interact with insurers more easily and efficiently. 3. Underwriting and risk assessment. Advances in data analytics and artificial intelligence are enabling insurers to improve their underwriting and risk assessment processes. By analyzing large amounts of data, insurers can better assess risk and price policies more accurately. 4. Claims management. Innovation is also transforming the claims management process by enabling insurers to process claims more efficiently and accurately. For example, some insurers are using drones and other emerging technologies to assess damage and process claims more quickly. 5. Fraud detection. Advances in machine learning and data analytics are also helping insurers improve fraud detection and prevention. By analyzing patterns and identifying anomalies in data, insurers can more effectively detect and prevent fraudulent claims. Innovation is enabling insurers to transform every aspect of their business, from product development to customer experience to risk assessment and claims management. Companies that embrace innovation are better positioned to stay competitive, meet the changing needs of their customers, and drive growth in the insurance industry. Subtopic H. Insurance distribution channels. Insurance products can be distributed through a variety of channels, each with its own advantages and disadvantages. Here are some of the most common insurance product distribution channels. 1. Direct-to-consumer, DTC, distribution. DTC distribution involves selling insurance products directly to consumers through online platforms, call centers, or in-person sales. DTC distribution can be cost-effective, and it allows insurers to maintain control over the customer relationship. 2. Agents and brokers. Agents and brokers act as intermediaries between insurers and customers, selling policies on behalf of insurance companies. They typically earn commissions on the policies they sell, and they often provide valuable expertise and advice to customers. 3. Bank assurance. Bank assurance involves selling insurance products through banks, either through a partnership with an insurer or by creating an in-house insurance arm. Bank assurance can be an effective distribution channel, as banks have access to a large customer base and can offer insurance products alongside other financial products. 4. Affinity groups. Affinity groups are groups of customers who share a common interest or affiliation, such as members of a professional association, investment groups, chamas, or alumni networks. Insurers can partner with affinity groups to offer tailored insurance products and services to their members. 3. Workplace distribution. Insurers can offer insurance products to employees through their workplace, either as a voluntary benefit or as part of an employer-sponsored group plan. Workplace distribution can be an effective way to reach a large number of customers at once. Insurance companies always pitch tents outside the premises of large companies such as banks, manufacturing companies, schools, etc., and talk to these employees one-on-one to sell insurance products. 4. Online marketplaces. Online marketplaces such as Amazon or comparison websites can be used to sell insurance products. These platforms allow customers to compare policies and prices from multiple insurers and can help insurers reach new customers who are looking for insurance products online. By leveraging these different distribution channels, insurers can reach a wide range of customers and offer tailored products and services to meet their needs. The key is to understand which channels are most effective for different customer segments and to invest in the right distribution strategies to reach those customers. Subtopic I. Role of insurance brokers and agents in business development. Insurance brokers and agents play a crucial role in business development for insurance companies. Here are some key ways that brokers and agents contribute to business development. 1. Market research. Brokers and agents have a deep understanding of their local markets and the needs of their customers. They can provide valuable insights into market trends and customer preferences, helping insurance companies to develop new products and services that meet the evolving needs of their customers. 2. Sales and marketing. Brokers and agents are responsible for selling insurance products and services to customers. They use their expertise and industry knowledge to educate customers about different policy options and help them choose the policies that best meet their needs. By building relationships with customers, brokers and agents can also help generate referrals and drive new business. Brokers and agents also play a critical role in generating leads. Building relationships with potential customers play an important role. They can help customers understand their policy benefits and claims by providing excellent customer service or product development. This feedback can be used to inform product development and to create new insurance products and services that better meet the needs of customers. 5. Risk management. Brokers and agents are often responsible for assessing customer risk and recommending appropriate insurance policies to mitigate that risk. By providing risk management advice and guidance, brokers and agents can help customers to make informed decisions about their insurance needs and can also help insurance companies to develop new risk management products and services. 6. Compliance. Insurance brokers and agents are responsible for ensuring that businesses and individuals are in compliance with applicable insurance regulations and requirements. They help customers understand their obligations and provide guidance on how to comply with regulations. Overall, brokers and agents are key players in the insurance industry, helping to drive business development through their market research, sales and marketing efforts, customer service, and risk management expertise. By leveraging the skills and expertise of brokers and agents, insurance companies can build strong relationships with customers, develop new products and services, and drive growth and profitability in the industry. They provide valuable sales, marketing, product development, customer service, risk assessment, and compliance support to business individuals, helping insurance companies to reach new customers and expand their market share. We have come to the end of the topic on the role of business development in the insurance industry. In our next video, we talk about the role of marketing. Development and marketing in the insurance industry. We have a 4-part video series that will look at these two very important functions exhaustively. As the insurance market continues to evolve and become increasingly competitive, it has become more important than ever for insurance companies to develop effective business development and marketing strategies. In these, we will explore how business development and marketing can be applied in the insurance industry to identify new customer segments, develop new products, establish partnerships, create targeted marketing campaigns, build brand awareness, enhance customer service, and analyze the competitive landscape. We will also examine the key skills and competencies needed to succeed in business development and marketing roles in the insurance industry. Whether you are an experienced business development or marketing professional, or just starting your career in the insurance industry, this video will provide valuable insights and perspectives on the critical role of business development and marketing in the insurance industry. Let's begin by looking at the definitions of both business development and marketing. 1. Business development. Business development is defined as the process of identifying and pursuing new business opportunities that can help an organization grow and become more profitable. It involves a wide range of activities, such as market research, product development, strategic planning, sales and marketing, and partnerships and alliances. The goal of business development is to identify opportunities for growth and profitability and then develop and execute strategies to take advantage of those opportunities. Business development often involves building relationships with customers, partners, and other stakeholders in order to create new business opportunities and drive revenue growth. 2. Marketing. Marketing, on the other hand, is the process of identifying, anticipating, satisfying customer needs and wants through the creation, promotion, and distribution of products and services. It involves a range of activities, such as market research, product development, pricing, advertising, sales, and customer service. The goal of marketing is to create value for customers and build strong, also generating revenue and profitability for the organization. Effective marketing requires a deep understanding of customer behavior, preferences, and needs, as well as an understanding of market trends and competitive dynamics. Both business development and marketing are critical functions in the insurance industry as they help insurance companies identify new opportunities, build strong relationships with customers and partners, and ultimately drive growth and profitability. And business development, we will be discussing each, delving into various subtopics as below. In business development, we will tackle the following. Importance of business development. Developing strategic partnerships. Identifying new business opportunities. Expanding customer base. Enhancing product portfolio. Driving revenue growth. Role of innovation in the insurance industry and business development. In marketing, we will look at the following. Market research in the insurance industry. Target market identification and segmentation. Product development roles in the insurance sector. By the end of the lessons, we Hello and welcome to our video, ladies and gentlemen. Today, we're going to explore a revolutionary insurance option that is transforming the way we approach car insurance, telematics insurance, or usage-based motor insurance product as it may be known by users. In this video, we will explain what telematics is and how it is being applied in the insurance industry to personalized motor insurance ratings and reduced costs of insurance. So, let's get started. What is telematics? Telematics is a technology that combines telecommunications and informatics to collect and transfer data over long distances. In the context of the automotive industry, telematics refers to the use of electronic devices and communication systems to gather, store, and transmit information about a vehicle's location, speed, duration on the road, and performance, among others. This technology uses devices that are installed in vehicles. These devices use various sensors and GPS technology to collect data about driving behavior, such as speed, acceleration, braking, and cornering, which is then be transmitted to a remote location where it can be analyzed and used for a variety of purposes, such as tracking vehicle performance, monitoring driver behavior, and improving road safety. This technology is used in a variety of applications, including vehicle tracking and fleet management, emergency services, and insurance. What is usage-based or telematics motor insurance? Telematics motor insurance, also known as usage-based insurance, is a type of car insurance policy that uses technology to track and analyze your driving behavior. With telematics motor insurance, a device is installed in your vehicle that collects data on your driving habits, such as acceleration, braking, and cornering. This data is then used by the insurance company to assess your risk as a driver and to calculate your insurance premiums. By tracking your driving behavior, the insurance company can offer you a personalized premium that is based on your actual driving habits rather than on assumptions about drivers in your demographic group. Telematics motor insurance can also provide feedback on your driving, giving you insights into how to become a safer and more efficient driver. Some telematics policies also offer additional benefits, such as theft recovery services or roadside assistance. Reasons why telematics insurance is gaining popularity. 1. Cost savings. Telematics insurance reduces insurance costs for both the insurer and the customer. The data collected from telematics devices is used by insurance companies to better assess risk and price policies accordingly. This is advantageous to insurance clients. Picture these two scenarios. Scenario A. We have a manager who owns a TX. The car is only driven to work, parked at the office block the whole day, then back home. Time on the road is limited to early mornings and late afternoons. Limited long-distance travel with the car and limited nighttime drives. The driver adheres to traffic rules and has no overspeeding concerns. Scenario B. A businessman who owns the same TX. This is a business car, therefore, he is always on the road for different meetings all day long. The businessman's programs also include weekend travels by car, and either because of the nature of his data for the above have been provided by telematics devices installed under the same or the same premium rate, that is, if the values are different.